Go ahead, Pierre.
Thank you, Christina. Thank you for giving me the opportunity to present this paper in this prestigious forum. It's really a pleasure. This is a joint work with Gita, Gopinath, and Ṣebnem Kalemli-Özcan. The views in the papers are ours and do not necessarily reflect those of the IMF or its executive board. The paper is titled Monetary Policy and the Short Rate Disconnect in Emerging Economies. The starting point is a recurrent theme in this conference, and it's the observation that emerging economies are largely exposed to shocks that originate outside of borders and experience large and volatile external financing conditions. In this context, it's been observed and argued that exposure to fluctuating global conditions may pose trade-offs and challenges to monetary policy in emerging economies. So, to give you an example, consider a typical external shock, a US monetary policy tightening, tighten financial conditions across the world, as shown by work of Ellen Ray, with the effects being particularly pronounced in emerging economies, as earlier work highlights. Well, in this context, it's been argued that face a trade-off, and you can think of this trade-off as the option of increasing or decreasing policy rates. Increasing policy rates in the wake of an external shock may alleviate a currency depreciation and capital outflows, which might be desirable, but at the cost of contracting local demand, domestic demand, and GDP growth. Lowering the policy rate stimulates local demand, but at the cost of further exacerbating the extent of capital outflows and currency depreciation. And so there's a question of where to stand in this trade-off that's been often articulated and characterized in the context of emerging market responding to external shocks. There is a related but distinct issue which speaks to challenges that might arise in economies that are largely exposed to fluctuating global conditions. This has often been cast in terms of dilemma versus trilemma, but what it means in practice is where you stand in the trade-off, whether you can transmit your monetary policy stance completely in a world in which your financial condition are partly determined by outside forces and global factors. In other words, does the global cycle and exposure to it limits your possibility to actively control domestic economic and financial conditions in your economy that's highly open. Okay, and so against this backdrop, this paper asks two simple questions. The first question is simply, how can we best characterize the behavior of monetary policy in emerging economies, okay, in response to external shocks, but even more generally? And the second is related to the second point I've made, which is whether global financial conditions challenge the ability of domestic monetary policy to influence the broader economy, and if so, how does this challenge manifest? So let me briefly run through what we do and find, and then I'll delve deeper into the analysis. So the first question was, what do central banks do in emerging economies? To answer that question, we collect, thanks to the BIS, a large set of policy rates, sort of consistently collected through advanced and emerging economies. And we find that monetary policy in emerging economies is best characterized to be countercyclical, at least on average. That is, on average, central banks tend to lower policy rates during economic recessions. And that's true both in emerging and advanced economies. We find that to be the case unconditionally after a US monetary policy tightening, as well as around notable historical episodes of global distress. We also find that you can't reject the hypothesis that the average emerging economies follows a Taylor rule with response coefficients estimated to be similar to those of advanced economies, raising policy rates in the wake of higher inflation, higher output growth, or output gap. Okay? Then we get to the second question, which is whether exposure to fluctuating global financial conditions might pose challenges to emerging economies. And here we start by showing that in emerging economies, there's a sense in which short-term market rates 3-month horizon interbank money market rates, as well as 3-month horizon government bond rates, tend to deviate from policy rates in emerging economies over the business cycle. Our metric that we emphasize is the short-term differential, the difference between market and policy rate. And we find that to be counter-cyclical on average in emerging economies, whereas in advanced economies, we find these rates to move very tightly, and hence the differential is small and acyclical. Importantly, we find that this object of interest, the difference between market and policy rate, or the short-term differential, tend to move with global financial conditions, such as the MB spread of a country, as well as with the degree to which a domestic banking sector is exposed to external liabilities, external financing conditions. Okay? And so once again, we find that there's a difference between the behavior of short-term market rates and policy rates, especially conditional on a set of external factors, and the differential between the two tends to move with external financing conditions and with the exposure of the domestic banking sector to these external conditions. And so this brings us to propose an explanation for at least part of this time-varying differential that relies on the idea that domestic banks rely in part on external funding, and they are the marginal investor in both the interbank market as well as the government bond market. And in this simple framework, we highlight that to the extent that external funding conditions are independent of the behavior of the policy rate, there is an incomplete pass-through from policy to market rates, and the extent of incompleteness and the movements in the differential are indeed related to bank external exposure and the movements in their funding and external funding conditions. So this paper is indeed related to a very vast and insightful set of other papers. The two contributions that we emphasize are, first, that there's a big discussion about how exposure to the global financial cycle and financing condition abroad might challenge monetary policy making in emerging economies. We argue that part of this challenge manifests through a time-varying differential in the policy rate and short-term local currency market rates, which are a linchpin to sort of broader financing condition in the economy. We argue that this has to be taken into account when writing models of business cycles for emerging economies, where short-term market rates and policy rate are often equated, with notable exceptions. And in this sense, it's also important to keep that into account when thinking about characterizing the monetary policy stance of these economies. Proxying the policy stance with market rates might lead to inaccurate conclusion about things like monetary policy cyclicality and its stance in general. Okay, so let me begin by characterizing the behavior of monetary policy rates in emerging economies. In this context, I'll show 4 pieces of evidence. First, estimates from Taylor rule. So I'll estimate Taylor rules and look at the implied reaction coefficients. I'll look at basic correlation between policy rates and GDP growth at different horizons. I look at the response of policy rates to identified US monetary policy shocks and more broadly to policy rates across countries around historical episodes of global distress, such as COVID or the GFC. The main data source for policy rates at the BIS when it comes to shorter market rates would rely on Bloomberg or the IMF International Financial Statistics. And importantly, our longest sample is 1990-2018, but for each country we select the time periods where the country belongs to a floating or regime, or to be more precise, where the country does not belong to a PEG regime, according to the classification of Ilsetki, Renard, and Rogov. So for example, for Peru, we include the policy rate starting in 2001 onward.
I was going to ask regarding that. Are you in your sample of countries considering inflation targeters, meaning successful inflation targeters, or more other countries too, like Argentina?
So the broader baseline sample exclude only PAGs, classification 1 of Ilsetti, Renner, Rogov. So we keep inflation targeted, but also countries that may not have achieved successful inflation targeting. We have sort of some appendices that look specifically at countries that follow interest rate frameworks as that are more sort of akin to inflation targeting precisely. So we follow Carvalho and co-authors in using an OLS panel regression to estimate a Taylor rule, which they argue is desirable in finite sample if the local monetary policy shock is a relatively small fraction of interest rate movements. So this allows also for some degree of interest rate smoothing. And what we find is that, first and foremost, we find that both in a panel of emerging economies and in a panel of advanced economies, policy rates tend to increase when inflation is higher, as well as when the output gap is higher than average. We see that the estimates are fairly similar across emerging and advanced economies, and they imply some Taylor rule coefficients that are fairly in line with estimates from the US with a significant degree of interest rate smoothing. Okay. We find similar results when we use GDP growth as a measure of slack, when we exclude high inflation episodes. And you might be interested in the fact that when we add the specification with exchange rate, we do find some degree of exchange rate targeting consistent with fear of floating, but the coefficients on inflation and output gap remain fairly stable and significant. And so that's that. Here, we want to sort of refer to an earlier literature that tries to characterize the cyclicality of policy rates. We do that with effectively dynamic correlations, where we regress the policy rate today and at some horizons ahead on current GDP growth and the lags of the policy rate. We do that for emerging and advanced economies, and this is quarterly data. So what we see is that both in emerging and advanced economies, the policy rate tends to be higher around period of high GDP growth, especially a few quarters out. But we also point out that the cyclicality is much smaller in emerging economies than in advanced economies. And when you couple this with the Taylor rule results from the previous slide, that's consistent with the idea that emerging economies are more exposed to supply shocks or shocks that cause supply type fluctuations and co-movements. We then condition on US monetary policy shocks. We use the high frequency identification of US monetary policy shocks sort of adopted by Gertel and Karady and recently updated by Yarochinsky and Karady. And what we find is that even condition on an exogenous US monetary policy tightening, the policy rate tend to decline, especially a year out. And that occurs in the midst of some GDP contraction, puzzling response of CPI inflation and capital outflows. Okay. Last, we also look more broadly at two episodes. One is the global financial crisis. So I plot the evolution of policy rates from August 2008 to August 2010. And what you see is that by and large, the decline in the policy rate occurs both in emerging and advanced economies in a way that's comparable across these two set of countries. We find that to be the case around the global financial crisis, as well as around COVID, another shock that's global in nature. Okay? And so these four pieces of evidence together bring us to argue that by and large, one can characterize the behavior of policy rates as indicating that the monetary policy stance in emerging economies is largely countercyclical, that emerging economies tend to lower policy rates during recessions, both unconditionally and conditional on some selected external shocks. So let me move to looking at the behavior of short-term market rates in these economies. So we want to do that because the policy rates are typically defined as the target interest rate set by the central bank in their efforts to influence short-term market rates as part of their monetary policy strategy to further influence a broader set of borrowing rates across the economy. The market rates that we consider in this paper are treasury rates, rate at which government borrows, as well as interbank money market rates, rates charged on short-term loans between banks. We focus on a 3-month treasury rate and a 3-month money market rate. The 3-month treasury rate is where we have most data, while being at the short end of the curve, and we do the same for money market rates. The baseline results that I'll show are for 3-month treasury rates. In the appendix, we have the same exercises run with 3-month interbank money market rates, and the properties are fairly similar across these two short-term assets. So this is the same set of dynamic correlation, asking what is the behavior of market rates as well as policy rates around episode of high GDP growth, or periods where GDP is above average. And so I'm overlaying the blue line I showed before, depicting the policy rate, with the cyclical behavior of the market rate. So what you see is that in emerging economies, in our panel of countries, the panel coefficient is estimated to be significantly different from the one capturing the behavior of the policy rate. So there's significant departure at a cyclical frequency between policy and market rates. In fact, here it seems that even qualitatively, the two tend to be different from each other. That's not the case in advanced economies, where market and policy rates tend to move very tightly, both qualitatively and quantitatively.
So Pierre, Andy here. So what's happening? Like, there is a spread between the market and the policy rate that is shrinking when the output gap, with the output gap.
There's a differential, and that's what I'm showing here.
Oh, okay.
There's a differential between the market and the policy rate that tends to be counter-cyclical in emerging economies, as you see here, by an estimated negative coefficient over a 2-year horizon. But in advanced economies, is across the board small and acyclical. So the difference between the market and the policy rate tend to shrink over booms and increase over recession, like any counter-cyclical spread that you can think of. But here we're looking at local currency short-term market rates that are not the key focus of much of the literature.
Sorry, Pierre, what's special about short-term assets? Like, there are counter-cyclical spreads on like longer-term assets. If you look just at the NBI spread, that's pretty standard. So what's special about looking at the spreads in the short-term market instead?
Good question. So as you said, it's been documented that there are counter-cyclical spread as long-term assets or very risky asset. Here we're looking at things that we typically think as proxying monetary policy stance. That's how we write models, and that's how we even often look at the data in our empirical analysis. And we find that, interestingly, at a 3-month horizon, there's a disconnect between these two. So in that sense, we find it interesting because we are not looking at typically long-term risky assets. We're looking at 3-month interbank money market.
So this is like a convenience yield on top of, whereas longer-term stuff have higher risk, like they're more risky, default, etc. This is more like a convenience yield story. Let's say something like that.
I'm not labeling the differential yet. We'll propose an explanation. There are different possible explanations that might apply, one of which is a convenience yield explanation. And even conditional on a US monetary policy tightening, you do see a fairly evident disconnect. While policy rate tend to decline, the treasury rate and the money market rate tend to increase in the midst of capital outflows and increasing volatility. Okay. And this is for emerging economies. The last piece of evidence along these lines is for a specific episode that might be construed as a US monetary policy tightening. This is the taper tantrum around May 2013. Bernanke made an announcement that revealed that U.S. monetary policy was going to be more tightened that people expected, causing turmoil in financial markets. And what you see is that in emerging economies, the typical response was a policy rate decline while market rates were increasing, as reflected in an increase in the short-term differential, the market minus the policy rate. Okay, so even in this raw data, you can see some sense of departure between these two objects. So let us then provide a potential explanation of this time-varying differential in market relative to policy rate in emerging economies, and sort of highlight and document that there's a relationship between this differential and global financing conditions in these economies. I'll present a very simple framework. In fact, it's a partial equilibrium model of the banking sector in emerging economies. Consistent with some of the papers that we've seen yesterday and discussed, here we put domestic banks of the emerging economy at the center of the mechanism, and we argue that they are the relevant intermediary operating in the home currency bond market, in the home currency interbank money market, as well as in the home currency bond market, government bond market short term. We have some evidence in the paper that highlights that indeed domestic intermediaries hold a significant fraction of government bonds and are still an important gateway to external financing, consistent with many of the papers in the literature. Our simple home bank will have asset side that consists of short-term home currency market bonds, which you can think of short-term government bonds or short-term interbank money market loans that deliver the market rate, RM. The liability side consists of home currency deposits, which we assume pay the policy rate, RP, as well as foreign financing, which are these dollar bonds that pay the dollar funding rate, R**. Importantly, consistent with some of the theoretical papers, predecessor ones, we assume that the dollar funding rate is different from the international funding rate. So there's a wedge that that foreign lenders require when lending to domestic intermediaries in dollars. In addition, consistent with prevailing regulatory regimes in emerging economies, we assume that these domestic banks are fully hedged in terms of currency mismatch, and they do so through forward positions that exactly insulate them from unexpected changes in exchange rates. Okay. And so in this simple framework, the home bank takes the policy rate as given, as well as the dollar funding rate. And based on that, determines sort of the required demand for home market bonds and the required price. Let me skip this. And so, very simply, the bank balance sheet consists of asset side equal to the current local currency value of market bonds, and liability side on the current local currency value of deposits plus foreign liabilities expressed in local currency. And as a result, the bank's profits on its balance sheet are nothing but the difference between the market rate and the funding costs, which are a weighted average of the local deposit rate, which is the policy rate, and the foreign borrowing rate, R*hat, once converted through forwards into local currency. Okay.
Pierre, can I ask just a clarifying question? You said CIP holds, but we have $2 interest rates and 2 local currency interest rates. Which pair? You have R* and R*hat.
Correct.
And then you have RP and RM.
Yes.
And so
what we are assuming is that CIP holds in terms of the market, the local market, when using local market rates and the foreign borrowing rate. I have to think more deeply if it fails.
Our RM and our hat, basically.
Correct. But that's a good question of whether it doesn't. Let me point out two things. So the first is that this omega at captures the reliance on foreign liabilities of the domestic banking sector. For the typical emerging economy, this is around 30 to 40%. And back to relate to this question, we had a version of the model where we assumed that CIP deviations occur, and so the relevant foreign borrowing condition had a wedge. In fact, it's still present here. Then we assume it away, but had a wedge there, and we had some regression pointing to some interesting relationship between the short-term differential and CIP deviation. But we could do it only for a subset of countries, so we didn't pursue that further. But I just wanted to point it out. That's consistent also with the evidence of Lorena Keller's paper that the banks' decisions indeed are affected by CIP deviations that they face. Interestingly, though, since we're here, regardless of what you assume about CIP deviation, if banks are hedged, like we assume, UIP deviation should not matter for their balance sheet and decisions here. And in fact, when we had explore relationship between the market rate and UIP deviation, we didn't find anything significant after controlling for the dollar borrowing rate. So after this digression, let me again show that these are the bank profits, which are actually predetermined at time t, given the assumptions about hedging. And under perfect competition and risk neutrality, you have that they will drive the market rate as equal to a weighted average of the policy rate, which is the deposit rate, and the foreign dollar borrowing rate once converted in home currency, where the proportion to which the second term matter depends on omega, the share of foreign liabilities in the domestic banking sector. And so what you can observe is that in a simple model, there's an incomplete pass-through from policy to market rate as long as the share of foreign financing omega is positive, and as long as that foreign financial conditions are not perfectly correlated with the local monetary policy rate.
A quick question here, Juan. So what determines omega? Here, over here.
Sorry.
Your left.
It comes from over there.
What would determine omega? I was thinking that, if these are two different ways of funding, if one is cheaper than the other one.
Yeah, no, that's a good question. And this is simple model that we assume it exogenous. Okay, so here we have it that we take it as given. We go into the data and see if it matters for this object. I agree with you that to the extent that bank can choose across different sources of liabilities, they would choose the smaller one. We see that in the data, they tap on both domestic and global funding markets, even though there may be differentials in them. So there might be forces that still force them to borrow from both. But for the sake of this paper, we take it as given today.
Pierre, over here. So just for narrative evidence, it seems to me that this is quite asymmetric, that when the interest rate goes down, in emerging countries, the pass-through tends to be smaller than when it goes up. Is that something you have checked that might speak about the industrial organization of the banking sectors? You can check it in your regressions, basically, right?
Is your narrative based on evidence? That's what?
Evidence in countries, yeah.
Okay.
I mean, maybe there is literature out there that has documented that.
I know we haven't looked at asymmetries, but certainly a good question to look into. So the simple model gives you that the pass-through from policy to market rate is incomplete as long as, and the extent of incompleteness is in proportion to omega. You can rewrite that simple pricing condition of the bank to express it in terms of the short-term differential or object of interest, and you see that intuitively it depends on the dollar funding premium, the extent to which the bank have to borrow at a rate above the international funding rate, and as well as the extent to which they're exposed to global funding conditions. So there are these two terms that in our simple model are relevant for the emergence of the disconnect. And that's what I said. Now, before moving on, let me just point out that even though this is a simple partial equilibrium framework with some admittedly stark assumptions, it's consistent with a number of mechanisms that have been found to be relevant in microdata from the banking literature. We've seen some yesterday, but let me just point out two studies from Turkey. One is an earlier paper by Ṣebnem with Di Giovanni, Ulo, and Baskaya. They do find that changes in global funding conditions as proxied by the VIX do transmit to local lending rates through the banking sector. In fact, banks that are more exposed to global funding conditions, bank with higher omega, do transmit global funding condition more. So by and large, that's consistent with this. Another interesting paper by José Luis Pedro, Fendolo, and Gülsen, also from Turkey, looks at a different shock. It looks at changes in the local monetary policy rate. And it finds that changes in the monetary policy rate, innovation to the Taylor rule in their context, transmit only partially to the local lending rate. And they transmit less for banks who can more easily tap into foreign funding markets. So that's consistent with the simple equation that I had in the previous slide, that to the extent that banks can tap into this market or that just rely in part on the foreign funding market, the policy rate transmission to the market rate operates only in proportion to the bank reliance on local deposits. More related and specific to our analysis, here we depict a set of estimated coefficients from panel regression from 30 emerging economies, and the regression consists in the short-term differential, the market minus the policy rate, on two measures of the dollar funding premium and the bank external exposure. As a proxy for the dollar funding premium of banks, we use the MB spread, which is country time specific. And to measure bank external exposure, we rely on earlier work by Ṣebnem and co-authors at the BIS, where they have a measure of the share of external funding share of external liabilities in the domestic banking sector. And so we have this regression that's motivated by our simple model, and we do find that indeed the short-term differential is higher for a country with a higher dollar funding premium, as well as for periods in which there's higher external exposure of the banking sector. In particular, we find that a 10 percentage point increase in the MB spread is associated with a 1.5/2 percentage point increase in the market rate above the policy rate. And similarly, a 10 percentage point increase in the bank external liability share is associated with about a 1.3, 1.4% percentage point increase in the short-term differential. We find that when we have both country and time, this is a monthly regression, country and month fixed effects, the estimated coefficients are fairly stable. That suggests that part of this relationship arises because of country time specific movements in both dollar financing condition, as proxied by the MB spread, and country time specific movements in external exposure. Okay. So ready to conclude. We find that indeed there's a sense in which global financial condition pose both trade-offs and challenges to central bank. A short summary of our analysis is that we find that by and large the monetary policy stance in the typical emerging economies is counter-cyclical, but yet we do find a non-trivial time-varying short-term differential between market rates and policy rates that seem to be related to foreign funding condition. It applies to both local currency interbank money market rates and local currency short-term government bonds. And we link it to the the important reliance of domestic banking sector on foreign funding conditions, which are large and volatile. Which are volatile. Thank you very much.
Thank you, Pierre. The discussant, Pablo Ottonello.
Okay. Good morning, everyone. Thank you very much to the organizers for inviting me to discuss this paper. It's a great pleasure to be in Peru. Let me start by saying that I think this is a very important paper for understanding the conduct of monetary policy in emerging markets. I enjoy very much reading it. There are two main contributions. One is the new empirical characterization of monetary policy conduct. And here, the paper highlights, if you want, some similarities that emerging markets have with developed economies that are, in a sense, different from what the previous literature highlighted, and the countercyclicality of monetary policy and the Taylor rule being two of those. And then that it documents this short-term disconnect, meaning there's a time-varying wedge between policy rates and short-term market rates. And then they discuss a model base of financial intermediaries pricing of these short-term market rates. Okay, so I'm going to go over each of these two contributions and do some suggestions as I go. So let me start by emphasizing why I think, one of the reasons why this is an important paper for our understanding of monetary policy, that there is a conventional wisdom in this literature to a large extent that monetary policy in emerging markets is often pro-cyclical. This, a seminal paper in this was a paper of When It Rains, It Pours by Kaminsky, Reinhardt, and Weg. And, that paper is about fiscal policy that's very well known, but also has a component of monetary policy. Here I'm illustrating it with this figure that has policy rates come from Weg and Bulletin that, is very similar to this, but has an advantage that is, Carlos Weg is also a Uruguayan, so he picked deliberately colors in the figure that are from Peñarol, okay? So it's a yellow and black. So this shows the correlation between the cyclical components of short-term interest rates and GDP between 1960 and 2009. And you see these developed economies are here, these black lines, and that includes those two. And you tend to see that those are positive for developed economies. You see that for many emerging markets, these are negative. And this is kind of a very well known fact in a sense. So this is what the paper is coming from and what the paper is challenging. So, Pierre shows this, that monetary policy in emerging markets tends to be counter-cyclical when what you do is to estimate these local projections where you have rates at different horizons in the left-hand side, and you have changes in GDP on the right-hand side, and you can trace here the dynamics of these policy rates and market rates. So, you see that in emerging market, in advanced economies, both increase during booms, and you see that also in emerging markets, the policy rates do, they increase by less, but they are also increasing consistent with what they do in advanced economies. Something here, if I were to try to tighten this with the previous literature, I will try to do, try to decompose, how much of these differences come from different periods, analyze it by country, try to tighten it the more that you can. But in any case, I think it's kind of a very important conclusion for researchers building models of monetary policy in emerging markets. Many of us sometimes try to say, hey, here I'm going to construct a model that, in which the government optimizes, and I'm going to try to match moments of monetary policy. So it's absolutely critical for our models that we see this. Okay, so the paper also shows that another sense in which we can see that cyclicality of monetary policies if we estimate some Taylor rules, and here you see also coefficients, positive coefficients in the Taylor rule in the response of policy rates to GDP. One component that I think the paper could emphasize more, that at least struck me when I saw it, is the coefficients on inflation, that emerging markets tend to be also quite responsive to changes in inflation. And here I think the paper could do more emphasis on trying to understand why, right? So here I'm just illustrating why this was surprising to me, at least. If I see inflation in emerging and advanced economies, this is for exactly the same sample that the paper analyzes, and we have here the median and different percentiles of the distribution. You see very, very different patterns. I mean, of course, this is not incompatible with what the paper is showing, but I think putting these the people into perspective of why, even though they follow these very similar rules, the outcomes of inflation are so different will be interesting to try to connect that. Then the second point that the paper has, in a sense, I think this comes, after you try to understand why the paper was different from the previous literature, you have like this extra result that is very interesting in itself, that is about this short rate disconnect. Okay, so the difference between policy and short-term market rates is procyclical, unlike advanced economies, and it decreases with U.S. monetary policy tightening. So Pierre showed this figure. Again, we have here local projections when the U.S. increases its interest rates. You have that these market rates increase following the U.S. rate, but we have a decline in policy rates. Okay, so I have a couple of questions here, or suggestions of what I will think will do more in this regard. So first, how do this look like in advanced economies? And here a natural question would be: are the market rates those that are disconnected, or the policy rates that are disconnected? We have many times a sense that the U.S. increases its policy rates and other economies follow. So perhaps what is different here that emerging markets are doing is what they do with their policy rates regarding that. I think then also more importantly, I'll try to focus more, in a sense, in domestic monetary policy shocks. We have ways now to identify those also for these emerging market economies. So if the paper wants to characterize this monetary policy in emerging markets, I think it will be a very natural object to look at. And that can be interesting to think about, at least in two dimensions. One is that it will be a key object to think about for monetary transmission, right? So if we think about, any monetary simple model that has a Taylor type of rule in which we have a household-Euler equation, what we are documenting here is this wedge that is at the rate at which these households, if you think that they will borrow or save at the same rate as the market rate, has a wedge with respect to the policy rate. Then for things such as determinacy, etc., or how much you should decline your rates if you have a contraction or if inflation is increasing, it's absolutely critical to know how much this wedge varies with your policy. What's the relationship between your policy rates and what the subject behaves. And the other thing is that it's also, I think, a useful object to inform about different models of this short-term disconnect. Okay, and this is, the last point that I want to make is about the model. Okay, so just to wrap up a little bit what Pierre showed, we have here a model of local financial intermediaries in which the marginal investor is this local intermediary and is determining these short-term rates. So they have two sources of financing, deposits and foreign borrowing with exogenous weights omega. And then they derive under these conditions a market rate that is a weighted average between the policy rate and this foreign borrowing rate. A point here, mimicking what Juan was saying, I'll try to endogenize these omegas. I think that's kind of a very natural thing to try to do to them all. But I think more broadly what I will try to do is to also try to discuss other potential models, mechanisms that we can think about what's driving this, right? So, here, for example, if you take the perspective of, for example, a global bank that this is just another simple model that you can think about for these, right? So you can have like a global bank that can purchase securities in the market economy and in the US, for example, and that intermediary uses its net worth, some deposits, and has some costly equity issuance. Well, that intermediary is going to equate the required return of the different risky assets here. So what we can be seeing here ultimately is that the response that we have for these market rates is just about intermediaries trying to equate the required returns of the different assets. And in this problem, we don't have necessarily the policy rate entering at all in the problem of these global intermediaries. So again, it could be that what is disconnected in a sense is the policy rate, while this is priced from these investors. Okay, so broader things also, it would be nice to see to what extent this comes from risk premium or from the term structure of interest rates. In a sense, we have here a policy rate, which is, overnight for many countries, a 3-market rate, so it could be some term premium going on with this. And also, I think it would be nice to emphasize, again, why is different? Like if we write a model of a bank, like what is the difference, or in any of these hypotheses, what is exactly different between the emerging and advanced economies, which in the model comes, in your model comes from the borrowing cost, which is the emerging markets are different, but in these are hypotheses, how would you think about that? And finally, one point to be made is I think the paper also could trace a connection with the literature on the short-term disconnect in advanced economies. These figures come from a nice paper by Moritz Lennel, Piasecki, and Schneider. So what they show here is the maturity in years in the horizontal axis, and then we have here yields. So they trace the yield curve, and they show that the very short-term rate has a discontinuity. So they trace what they call like a shadow rate. That will be the rate implied by this yield curve, and then they show that it has interesting movements across the cycle. And one that I found particularly interesting, for example, is in the Great Recession. You have this decline in the short-term rates, but then the shadow spread goes up. So I think it's there are a lot of models that have been written, including in this paper, connected with that. So I think it would be nice to check, in a sense, what's the level of this. I mean, everything you do is about these changes, but it would be nice to see if there is indeed some discontinuity in the policy rate, and if so, also do the models that we know for developed economies, could they tell us something about emerging markets? Thank you.
Thank you, Pablo. Go ahead, Pierre. You can react a little bit, and we can collect some questions in a minute.
Thank you very much, Pablo. This was very, very good and certainly useful. I can't address every question, but let me say that I think your discussion made me think that there might be value to further enrich the model to think through what might be behind this volatile funding condition of the domestic banking sector, which might as well arise from global bank time varying price of risk, for example. And that would also lead you to sort of having that endogenized lead you to understand what you should expect in the wake of different shocks, the local monetary policy shocks or other shocks that are local in nature that you can identify. So that's certainly a route we can pursue. But by and large, we wanted to point out that if those conditions apply in the simple model, then you would already have a disconnect. And then, of course, let me also say that while we hypothesize that the disconnect result from time-varying marginal cost of the domestic banking sector, so that we don't rule out alternatives that might be based on default risk. I mean, Arellano, Bai, and Mihalache have a nice paper with sovereign default risk in a New Keynesian model, where you have a sense of a disconnect already there. That could be an alternative, or a time-varying price of risk for term risk that you have mentioned. And in this sense, I'm very sympathetic to it. And this might also inform one on different inflation dynamics. Even though two countries follow the same Taylor rule, that there may be a different shock structure or different mechanisms, like the one we emphasized, that might lead to different inflation outcomes in equilibrium. That's certainly a possibility. It'd be certainly useful to relate to Lenel, Piazzesi, Schneider. Let me point out that the notion of disconnect, even though we call it the same way, it's a different object. So they equate the short-term bond rate with the policy rate, and they say it's different from the shadow rate that would be implied by the term structure. We have a different notion of that, but there's certainly a relationship to be drawn there too. So thanks again, and we'll talk more, I'm sure, and I'm happy to take questions.
Yeah, so I'll take the first question. So I think it's super interesting. I think it would be useful, sort of just following up with my earlier question, to think about these results for economies that are following successful inflation targeting regimes. Think about Peru, Colombia. I think that there's interest in terms of whether, for example, for this disconnect, whether it matters if you're thinking about these economies versus you're thinking of, or Turkey, Argentina type economies, which of course suffer from other chronic credibility issues. So I think that is sort of, I don't know if you want to make it your baseline. For me, I would probably do the baseline, the emerging economies that have been successful inflation targeters, but at least a very important sort of lesson to think about whether it matters. The other, so that's my first comment. My second comment is on, and this is following up with what you just said, which is, you can have different co-movements based on the prevalence of, let's call it, demand versus supply shocks. And, the relation between, for example, inflation and output is going to crucially depend on that. And the monetary policy response could be different too. So, whether or not, some of the differences in, for example, the difference in the extent to which a monetary policy response to output correlates with output, whether that is just a sort of a difference in the incidence of shocks, which sort of emerging markets have traditionally been very supply shock driven. So those are my two comments.
Thank you. Yeah, thank you very much, Christina. Briefly, we do have that our main results hold for countries that closely follow an interest rate based framework, like Peru, Colombia, Brazil. And specifically those time periods. But I mean, I see the justice of your point of making that a baseline, and I agree. We also very much agree with the notion that when you see cyclicality between policy rates and GDP growth, you have to be very careful in interpreting that as monetary policy going pro-cyclical or monetary policy following a standard Taylor rule, but just the underlying shocks are supply based. So we argue that you have to look at Taylor rule estimates and cyclicality together to interpret what we find. And we agree with you that a mild correlation between interest rates and output growth may just be reflective of supply shocks or even sovereign risk, like in your paper, that manifests itself as a supply type co-movement.
I have time for one more question. Can I? Yes. I have two comments. First one, I want to echo what Jorge was saying, which is I think the banking competition can also, there's a large literature in banking in the US and developed economies that discusses the fact that bank competition and the lack of bank competition is actually going to affect the pass-through of monetary policy rates into their banking rates. So thinking about, how competitive are these banking sectors might start giving you a little bit more power. The other thing I wanted to say is that thinking about external financing, the IMF has fantastic data on this in the financial stability reports. And you can see that the amount of external financing that banks rely on is very diverse. So while Latin American countries in general have less than 10% and sometimes 2%, when you think about Bolivia, about their external financing coming from money market funds, the majority of their financing comes from core financing, which is deposits. And thinking about, so this is going to be your W there, and thinking about what drives this W, I think connecting to what Christina was saying, that maybe W is coming from inflation stability or any type of macro shocks is going to be really important, because it's going to be very different in a story like Turkey, who has like 60% of their external financing coming, from external, versus Peru, who has less than 10%, is going to be very different. Thank you.
Select a couple. Yes, Mark.
Thank you, Juliana.
So just I just want to echo something that Pablo was saying and Christina. I mean, when I was looking at this, I was also thinking of 2008 in the U.S., where we saw this, big gap between the market rates and the policy rates, and we kind of have an idea there that the problem was in the financial sector. And then the thing I thought was that maybe most of the GDP variations in emerging markets involve the financial sector. So it might be useful to look just like at commodity shocks or something that is not originating in the financial sector or involving a heavy financial sector, just to see if it still holds, conditional on the type of shock.
There could be a mechanism going through the financial sector.
There could be, and you could include measures of financial sector health and the things that we have in the
It makes
US.
perfect sense. Thank you.
But I mean, yeah, so the 2008 is just like a big example that's consistent with your story for emerging markets, but obviously has nothing to do with currency.
Well, I think Juliana made useful observations that we take and we'll discuss and think through, and same for Mark. I think we can learn a lot, echoing what Pablo said, from looking at conditional and different shocks, how this behaves, and then that would inform us of when it comes from. But a difference that we want to point out is that this time-varying difference in market relative to policy rate is something that occurs more regularly in emerging economies than or just episodes of extreme crisis. And I'll leave it at that.
So to complement Pablo's point, so U.S. monetary policy also affects exchange rates, commodity prices, and trade imports, right? So so then it might be just policy rates responding differently because they are differently exposed to this emerging advanced, right? So is that something you have control for, you have considered?
Any other question?
Yes, very interesting and useful contribution. I enjoyed it very much. Just a couple of comments about the modeling, though. I'm not sure that I understood the bank's problem in your model. I mean, if the bank actually chooses assets and liabilities subject to market rates and policy rates and funding rates, then the condition that you mentioned was not really like the demand function of the bank, but it's an equilibrium condition. And this is actually important because, the interpretation of your LAR regression actually is the other way around. It would be the omega, the choice of how the bank funds itself, the dependent variable in a way that not the other way around. But anyway, so that's a minor comment. The other comment is actually, I think that your results are very consistent with a class of models that has been discussed in the past, which is the models of balance sheet effect. I'm saying this because it is very natural to think in these kinds of models that, for example, an adverse shock in an emerging economy actually results in exacerbates financial frictions and increases spreads, right? And that's exactly what you're trying to say, that in emerging economies the spreads increase, and that's because financial frictions actually are and agency costs increase, right? And that actually explains the disconnect, right? I mean, what is the difference between emerging economies and advanced economies? Well, financial frictions and financial imperfections are more prevalent in emerging economies. In fact, in that literature, there is already a notion of disconnect. I mean, if you look at the papers that Velásquez wrote, years ago, we did make a difference between what we call the financially robust economies and financially vulnerable cases, actually, and that difference is actually it's the same as the disconnect difference that you're talking about. So I would urge you to actually look at that literature, because you may find a much, I guess, more convincing and useful for policy purposes, to actually think about your results.
Yeah.
Thanks for these comments. I agree that the disconnect might result from agency frictions. We left it unmodeled in a way, but you could make it like that. I'm familiar with your work, and I'm very sympathetic to the idea that mechanisms of that sort might result in that. Recollection is the part of the work is real in nature, and the relevant spread is not exactly the policy relative to interbank, but you might correct me.
There are versions of those kinds of models. Like, for example, there is a very interesting paper. One of the earlier papers is by David Cook and Choi in 2004.
Yes.
Like, for example, they have banks, and I suspect that they have the same kind of effects that you're mentioning.
Okay. Okay, well, thank you very much, everybody. Let's do one round of applause. And we'll be back at 10:15. happy to have Vincenzo Quadrini to present our second paper of the day. The title is The Surge in Emerging Markets, International Reserves, and the Rise in Global Volatility.
Yeah, thank you.
Yeah.
Okay, so thank you so much for including the paper in the program. And as you can see, this is a joint paper with Enrique Mendoza. So let me start with the picture that motivates the paper. So when you look at the last 30 years approximately, you can see that emerging economies increase quite dramatically the volume of foreign reserves. Okay, there has been also an increase for advanced economies, but the increase in emerging economy is really large. Take also into account that those numbers are in as a percentage of GDP, and take into account that emerging economy grew much faster than advanced economies, so they are much bigger. So in some sense, from a global point of view, the accumulation of reserves is quite impressive. Okay, but at the same time, it's also true that the supply of reserves have been increasing. So, in other words, when you look at the debt, public debt issued by advanced economy, you can see that especially following the financial crisis increased quite significantly. So in some sense, on the one hand, you have those advanced economy that issue public debt, and this public debt is purchased by emerging economy. The question we are interested is what are the credit market implications of this increase in accumulation reserves, and also in the issuance of public debt by advanced economy. So, one of the implications we are interested is also what are related to macroeconomic and financial volatility. Okay, so that what we would like to understand. Okay. So, how do we address the question? Essentially, we are going to build a model. Okay, a model that we bring to the data. So the quantitative application is the central part of the work, and this is a model where there is issuance of public debt, of private debt. Okay, and is a debt that is defaultable. Okay, and private default represents what generates a crisis here. Okay, and the central feature of a financial crisis is a redistribution of wealth from away from lenders to borrowers, and that is that redistribution of wealth that then generates macroeconomic consequences. Okay, that debt is defaultable, so of course, if you are a borrower, you might not repay, but for those who buy the debt, okay, and that represents an asset. And that asset is important because it's a sort of an input of production. And consequently, if you are someone that holds the debt and there is default, essentially what happens is that your assets are going to decline. Okay? And the decline in your assets will have a negative implication for production and so forth. The main exercise is conducted through counterfactuals, okay? And through those counterfactual exercise, what we are going to show is that this increase in holding accumulation of foreign reserves by emerging economy has the following implications. First, leads to a reduction in the interest rate, world interest rate. Okay. And the decline in the world interest rate actually generate greater financial and macroeconomic volatility in both advanced and emerging economy. Okay. On the other hand, the increase in public debt, so issuance of more public debt, has in some sense the opposite effect. Okay, it increases the world interest rate, and by increasing the world interest rate, actually has the counter effect of making financial macroeconomic volatility lower. That essentially is what we are going to show in this paper. Now, let me give you the intuition of why this happens, and then I describe the model, and as I said, the quantitative application is the most important part of the paper. So, what happens when countries, in particular emerging economies, accumulate more foreign reserves? Essentially, what happens is that the price of that debt is going up. So the interest rate, the yield is going down. Okay? But if the interest rate now, the world interest rate is lower, of course, borrowing is more attractive. Okay? And as a result, there will be an increase in leverage. Okay? Now, once you have more leverage, and that happens in both emerging and advanced economy, if something goes wrong, so that will be a crisis, means that with this higher leverage, readjustment through through default essentially will be bigger, and this will have greater macroeconomic implications. That is why this accumulation of international reserves might lead to greater macroeconomic instability. Okay, it's true basically higher leverage. Okay. Well, for public debt is from advanced economy is the opposite, because now if you want to sell your debt, you have to offer higher interest. Okay, but then for the private sector, when the interests are high, it's less. There are less incentive to borrow. So lower leverage, and if crisis emerge, then there will be less need for a readjustment. Okay. So that is what essentially we show in the paper. So what I will do, I will describe now the model. I will describe how we bring the model to the data, and then I describe the counterfactual. Okay. So this will be a two-country model. There will be a country, one that is representative of emerging economy, and there is a second country that is representative of advanced economy, of emerging economies. Okay. In each country, there are three types of agents. Okay. So there are the net borrowers. Those in our model will be producers, of intermediate goods. Okay. There will be a second, let's call sector or type of agents. Those will be instead those who have a positive financial position. So essentially they are net lender. Will be another kind of firms, but we model as entrepreneurs. It will be the final producers. And then there will be the household sectors, but the household sector here plays just a very an important role beside providing labor. Okay. So why do we need to split the production sector in two? Okay, because we want someone who borrows, someone who lends. Okay, so there will be within a country there is a borrowing and lending. Okay.
Vincenzo, is that something you typically observe in the data? Intermediate good producers borrowing and
no, that is purely a modeling strategy to make the production, the two sector complementary. Okay, so in other words, what happens is the intuition is sort of very simple. I am the customer of what you produce. Okay, now if because you are intermediate producer, I'm the final producer. So I buy your intermediate goods. Okay, so when my financial position deteriorates, I don't buy your goods. And that is what generated a recession. Okay, so we decide to model this way through intermediate final producers, but it can be done in other ways. Maybe through production function that simply complementary. Okay, what we don't want is this. We don't want that they are substitutable, because I am in a bad financial conditions, so I cannot produce. Fine. You are in a slack position, then you just substitute, you produce more what I don't, and won't have any effect. So in a sort of a new Keynesian, that the demands come from consumers. Okay, so when the consumers cannot buy goods, then there will be a decrease in demand. Here instead comes in our paper, it comes from final producers. Okay, through intermediate producers who are the ones who employ labor and so on and so forth. Okay, but again, what is important here is that a crisis, the way I will describe, redistribute financial resources. Okay, and that is what is really matter. There is, of course, I'm talking about accumulation reserves and the issuance of public debt, so there must be also a garment sector. And but the garment is passive, so the accumulation of reserves and the issuance of public debt is purely exogenous. So we don't have anything to say why they do that. Okay, although at the end I will have some comments about that. Now, for instance, the garment budget in advanced economy will be they hold some foreign reserves, they buy some public, they issue public debt, so PIF stands for public, and at the same time they buy the foreign reserves, they have the old debt, and then they make transfers to households. Okay. But all those things are exogenous, except that T will be endogenously determined through the budget constraint. Okay. Similar is for country 2. The only thing is that emerging economy don't issue public debt. Okay, so that is why you don't see here this variable, okay, for emerging economy.
Vincenzo, one question. So the government cannot use the reserve to insulate the economy from shocks? I mean, if they have accumulated a lot.
So you are saying that they might use the foreign reserves to help the economy? Yes. Yes. So for the moment, no. Then we have an extension in which they do. Okay, will be at the end. For the moment, we want to focus on the financial markets implications, rather than using foreign reserves for potentially smoothing out the consequences. But we will have the extension with that. Okay, so let's start with this net borrowers. So those are producer of intermediate goods. They produce with the standard production function, labor, and capital. Okay, and they, of course, they will have the maximized profits, but essentially this is the neoclassical producers. Okay, what is additional to the standard neoclassical producers that they can borrow. Okay, and they borrow some amount. Let's say they borrowed DT in the previous period at the price QT, and then they promise to repay DT. But here comes the default assumption: is that when T comes, the firm has to repay that amount. He might choose to repay less. Okay, so the repayment rate is delta. Okay, so if delta is equal to 1, means that he repays 100%. If it's lower, means that there is default. Okay. Okay, now the assumption that we make about default is depends on the liquidation value of the capital that those firms hold. So if the liquidation of capital liquidation value of capital declines and it goes below the debt, then that is where there is default. So this is like the firm is underwater. Okay, so this little L represents essentially the unit value of the capital that the firm owns. Now, the assumption that we make about this liquidation value. Okay? So the very simple way to justify fluctuation this is to say, okay, in normal time, the value of our unit of capital is just, okay? But there could be some situations in which that liquidation value drops, okay? And it becomes what we call this kappa, which could be lower, of course. Actually, will be lower than 1.
Why for the default, the firm evaluates the liquidation value of capital?
No, this is the lender. So the lender says, okay, now you are not repaying, I'm going to take your capital. How much I can recover from that? And will be this L. Okay. Now, of course, here it's a very stark assumption that we justify with some liquidity assumption. So at the end of the day, but I don't want to go into those details for this presentation because I don't have time. At the end of the day, we interpret this as some self-fulfilling price. You wanted to ask a question?
Yeah. What's the timing of? Isn't it the liquidation of tomorrow that matters for the default decision?
Yes. So today I borrow. So let's go time t-1. Okay. So I borrow dt. Okay. And at this price. Now I go to time to period t. Okay. And I'm supposed to repay this. Okay. Now, however, I realize that if the creditor confiscate my capital, it can recover only this little, a lower price, okay? Now, if that value is below the debt, then I'm going to renegotiate and bring back the value to the liquidation value. That is the essentially the assumption. Okay, okay, very good. But for the moment, for my presentation, all you have to remember is this: is that you the firm borrow, he enters the next period, all of a sudden this liquidation value drops. If the liquidation value drops sufficiently below the debt, there will be renegotiation and the debt gets rescaled.
But there is no dead weight loss anywhere.
There is not, sorry?
Dead weight loss.
No, no. No, exactly. So here is purely this, when this default arises, is purely a redistribution of wealth away from creditors to borrowers. So in some sense, those firms is good to default. Okay. Now, of course, that will be captured by the price, obviously. Oops, now I went too far. Wait a sec, why it doesn't go back this one? No, wait a sec. Oh, I'm going the opposite way. Wait a sec, it's going. Okay. Yes, okay. Yeah, correct. So, of course, when I issue this debt, okay, this price will capture the possibility of default. So it will be priced at. Okay? And here firms are risk neutral, right? So obviously that the fact that the Q increases because I repay less, it doesn't matter for the firm. It doesn't. Because it's purely capture. What matters for the firm is really the expected cost. And so this means that those firms, as long as the interest rate is lower than the intertemporal discount rate, they will like to borrow as much as possible, provided that the interest rate is lower than the intertemporal discount rate. Okay? So to prevent that, we assume that as the firm borrows more, there will be also a cost. So this is a deadweight loss here. Okay? So it's the equivalent of a borrowing constraint. Okay, but rather than imposing a strict borrowing constraint, we assume that there is this increasing cost. Okay, but conceptually is a similar idea. That's it. So this is how the cost looks like. Okay, very good. At the end of the day, with that cost, what happens is that, very simple, without going to the algebra, is that if the interest rate is lower, okay, those firms are going to borrow more. Okay? What stops them from borrowing is that as they borrow more, then the cost kicks in. Okay? That's it. So that already shows that if the interest rate is lower, there will be more leverage. That is a sort of a mechanic from this side. Okay, now let's look at the final producer. Remember, the final producers are the ones that buy the goods from those intermediate producers. Okay, and here, however, we model final producer as heavy concave utility, and let me explain why that is important. Is because here we want some endogenous accumulation of asset savings. Okay, so those are the firms that hold financial assets. Okay, this is sort of the firm with cash. Okay, but we need some way to have a well-defined way for them to accumulate those the cash, and they will do it through savings. Okay, and their production is very simple. They buy those intermediate goods. There is a productivity, and this is what they produce. But when they buy the X, they pay a price. Okay, and now the key assumption is this one. So when they buy the intermediate goods, okay, they need to have liquidity. So they will be the financial assets that they hold. Okay. So where do they get those financial assets? Of course, on one I say issue liabilities, right? In part, that will be the firms that I described before. So the firm borrows, those final producer buy those bonds. That will be the liquidity that you are going to use in production. In production, meaning to buy those intermediate inputs. Okay. So now you can see what happens here is that if there is default, these accumulated assets will drop. So those firms don't have enough funds to buy the intermediate inputs. Okay? So if they don't have enough funds to buy the intermediate inputs, what happens to the price of the intermediate inputs? Drops. So for the intermediate producers, will be like a productivity shock. Because now what they produce, they have to sell at a lower price. And the way they react is by producing less. Okay. So this is essentially the way it works. Now, this is the important part showing what M contains. Okay. So those, remember there are two countries, right? So they can hold bonds issued by private sector in country one. They hold bonds issued by private sector in country two, and they might hold also public bonds. Okay, so they solve a portfolio choice. So this is another reason why the concavity is helpful, because now the portfolio choice is well defined. Because remember, those private bonds are risky. Okay, so they are not perfectly substitutable. So they would like to hold both of them. Okay, for portfolio diversification, given the concavity. Okay. Okay, but now, once they enter the period, if there is less repayments, you can see that they're well. So delta will be lower, so the M will be lower. And so now they don't have enough liquidity to buy those intermediate goods. So in some sense, it's like a demand shock, because they cannot buy those intermediate inputs. Producers of intermediate inputs, they will not produce as much. So this is essentially how they model
Vincenzo, one question. The shocks are aggregates?
Yes.
Okay.
So the shocks will be aggregate. So the only shock that we consider, because we think about a crisis, okay, will be essentially the drop in the liquidation value of capital. Essentially. And those will be aggregate, but country specific. So a shock can happen in country one or in country two or both. Okay, it can happen. Now, however, because those entrepreneurs hold a diversified portfolio, okay, even if the shock happens in the other country, it will affect my portfolio. So it will generate a recession also in my country. Mm-hmm. No, it's not that. Yes, no. Okay, the private debt is not safe, so because there could be default, but the public debt issued by advanced economy is safe. So there is no possibility of default. That is why you might want, provided that they are properly priced, you would like to hold all of them in your portfolio. So if you are talking about using this B to fund your working capital, no.
Thank you.
Okay.
Vincenzo,
yep.
Quick question. Isn't it enough with having a downstream, like reverse trade credit? The downstream just pay the orders in advance, so the supplier gets liquidity, but sometimes the downstream buyer gets shocked, and then isn't that enough for the mechanism?
Yeah. So you are thinking rather than holding my financial liquidity, okay? You are saying that I borrow from my supplier.
The lender still the final good, but you pay before for the order.
In some sense, is the same. Yes, sure, could be similar in the sense that you pay in advance and then the supplier doesn't deliver the goods.
Like the fee is equal to 1, but then
right.
Yeah.
Okay. It could be the same. Okay, there is the household sector, but the household sector essentially they provide labor. Okay, so when the wages are higher, they work more, and when the wages are lower, they work less. That's essentially what it does. So summing up, entrepreneurs are those that are the lender with a positive financial position, the old financial assets, which are needed for production, and who creates those assets are the intermediate firms, are the borrowers. Okay, it's also the garment of advanced economy. Okay. Firms default when shocks reduces the liquidation value of the collateral. Okay, and default redistribute wealth. That is essentially the mechanism. In some sense, this is similar to the paper of currency mismatch that Ferrante presented yesterday. There was also through banks. Okay, the banks essentially they get this currency shock, so the net worth drops, and the data as consequence. So here, in some sense, it works in the similar way. Okay, there are no banks, but I call entrepreneurs, but it's a similar idea. Now, the fact is that when those borrowers they hold a lot of debt, okay, and that default means that the drop in financial wealth of entrepreneurs will be bigger. Okay, and the bigger drop in financial wealth will generate bigger macroeconomic consequences, because of course if I lose more, now I have a proportionally bigger quantity of financial asset that I can use for to buy intermediate goods. So this is how it works.
Sorry, Vincenzo, just a quick question. The liquidation value, so it's completely exogenous.
No, it's not exogenous. So we have the macro foundation through self-fulfilling expectations, but requires 10 minutes just to explain that. So I would like to.
It's not moving with interest rate. There's no price of capital which moves with interest rates.
No, there is when the firms buy capital, it will be the price is always one. Okay. The question is, if you confiscate my capital and you try to resell, okay, are there firms that have liquidity to buy it or not? if there are no firms who value the capital 1, of course, but if they don't have the liquidity because they are in default, then you had to receive a lower value. That's essentially the idea. Okay, so let me, the quantitative analysis. So here how it works. Okay, so there are some parameters that are not many, that are calibrated essentially. Okay? Now, the thing is that there are some exogenous variable here that they change exogenously over time. Okay, so we need to use the data to construct those variables. What are those? Is productivity. Why productivity matters? Because when one country grows faster, has a general equilibrium effect that needs to be taken into account. Then there is this variable which is related to financial structure, actually both phi and kappa. They also change over time. Okay, this is in some sense a process of financial development. And then, of course, the reserves show the first graph that changes, and the public debt. So in other words, we have to, for foreign reserves and debt, we can simply look at the data, obviously. But for those others, okay, we have to back up those variables through the model we need. Okay? And how do we do that? So essentially the way we do for Z will be a solo residual analysis, the typical stuff. Okay, production function, we have a measure of inputs for those two sets of countries. Okay, we have output, so as a residual, we construct a series for Z, TFP. Okay, for those is a little bit more complicated. Okay, so we need to look at financial variables for those two countries, and the financial variables that we look at are, let me go directly there, are basically those four variables. So this is private domestic credit in advanced economy, private domestic credit in emerging economy. We have the net foreign asset position of the advanced economy. Of course, for emerging economy will be just the same number, but with a negative value. And then we have the US interest rate. Okay, so with we have 4 series. We have from the data we have 4 exogenous variables that we need to back up, and this is how we constructed those series. Okay, okay. So let me last thing, and then I show the result graphs. Okay, so how do we measure volatility? First of all, what are the aggregate shocks? It's basically this liquidation value of capital. Okay, sometimes it's 1, sometimes it drops. Okay, and that can happen in country 1, can happen in country 2, or both can happen. Now, of course, those are low probability events because we think about those as crises. Okay? In fact, the way we calibrate is 4% annually. Okay? So on average, every 25 years, it happens. Okay, so these are the only shocks. So the way we do now, we simulate the model with random draw of those realization. Okay, and but of course, every time we feed into the model those random draw, we get different outcome from the model, right? So we repeat that 10,000 times. Okay, so we draw a sequence of shocks, feed it into the model, we get the outcome. Then we go back, we draw another series, feed it into the model, we get a different series, and we do that 10,000 times. Okay, so now we get, for each year, we get 10,000 observations. Okay, so what we do then, we for each year, we calculate the 95 percentile, we calculate the 5 percentile, and divide by the mean of output for that particular year. Okay, this is a lot, sort of, if you want, Monte Carlo simulation. Okay, so That,
just to make sure I understand. So you have a process for these three variables?
these actually are series, deterministic series, and they are perfectly predicted. They are. So they are always the same in this simulation. Okay. What is not the same are this shock of, do you remember that L liquidation value? Okay, that is what is drawn stochastically.
And it's an IID shock around?
Yes, yes.
And Vincenzo, what do you assume for the public debt of the advanced economy?
So they are like in the data. Okay, so in other words, we just look at what is the foreign reserves. We look at what is the public debt, and then we assume that that is going to evolve in the model as in the data.
But the private sector also can hold public debt of the
Yes.
advanced economy.
Yes.
So don't you need that series as an independent series?
No, but that will be an endogenous choice. So in other words, there is a supply of public debt, and then there is the private sector that chooses how much to buy of that debt, and that, of course, will determine the interest rate that will be market clearly determined. Okay, so now we want to do the counterfactual. Okay. Let me explain the counterfactual. So there are many variables that change over this period, and those variables are changing on a deterministic way to replicate the data that we want. Okay. Now the counterfactual is, okay, what about the case in which the emerging economy did not increase the amount of reserve over this period? That would have been exercise. The other is, what about if advanced economy did not increase their public debt? So we'll see how the prediction of the model is going to change if those reserves were not going to increase and if the public debt was not going to increase.
So in these cases, the transfer, the T is adjusting, making the
Yes,
adjustment?
the transfer is always determined by the government budget constraint. So if the government changes the sequence of public debt, for instance, then also the transfers will change. Doesn't matter because we model the households as risk neutral, so it doesn't really matter. Okay. Yes. Okay. So this is just the baseline model where everything changes to replicate the data, essentially. And this, what is this? This is our measure of volatility. Okay, so this is the difference between the 95th percentile of those simulations and the 5th percentile. Okay, so there has been an increase in measured volatility both in advanced economy and the emerging economy, but remember this is only related to the crisis that we financial crisis. Okay, okay. And why there has been this increase? Various factors contributed to that. Okay, but what we want to understand is what was the contribution of accumulation reserves and public debt. So now I'm going to assume that I repeat those simulations, but exactly in the same way, but I assume that the foreign reserves did increase over this time. Okay? And this is what would have been the aggregate volatility if the foreign reserves of the emerging economy did not increase. And you can see that volatility will be lower in both emerging economy and in advanced economy. Why is that? Very briefly, it's because you see the interest rate drop, but if reserves stay the same, okay, the interest rate would have dropped less. So there would have been less leverage in both countries. That's essentially the intuition. Okay. Lastly, because I think it's 1 minute, right? Okay. For the debt, the debt, the public debt, the same counterfactual experiment, but now we shut down the increase in public debt. Okay? that would have driven higher volatility than we actually compute through the baseline model in both countries. So in some sense, what I'm trying to say here is that, yes, on the one hand, you have those emerging economies that are accumulating more reserves. It seems to lead to greater volatility. But on the other hand, there are the advanced economy that is providing those reserves. Okay? Okay, so let me conclude. One thing that I would like to say is that we do not conduct a welfare analysis here. For instance, these foreign reserves are not chosen optimally by the government. Neither the debt is chosen by the government. But there could be interest in study those issues. In particular, because here, when those countries accumulate reserves, maybe they don't internalize that when all of them are accumulating reserves, may lead to a lower interest rate. Okay, which suggests some sort of externality. But it's also true that when they buy more public debt, then the advanced economy have also incentive to issue more debt. Okay? So this certainly is an issue worth exploring. Thank you very much.
Well, let's see. Well, thank you very much for the invitation to discuss this paper. I really enjoyed the paper, and also thank Vincenzo for sending me the last version of the paper a couple of weeks ago. So this is a very provocative paper because it challenges conventional wisdoms about the role of foreign exchange reserves in reducing risk for a particular economy. So what they do is they propose a model of emerging and advanced economies in which the private sector issues defaultable debt, which has a productive use for its users. And the main results show that this surge in emerging market reserves contributed to the fall of the world interest rate, and by that induces more leverage. And the higher leverage increases financial and macro volatility at the global level. All results is that the public debt reduces volatility, and that's because it crowds out the private sector leverage. And lastly, although Vincenzo didn't show it, reserve finance bailouts will reduce volatility. So what I want to do is to focus on the transmission mechanisms of the model, and then I will talk about the bailout mechanism that they propose in the paper, and finally talk broadly about macro and financial volatility and some aspects that are not in the paper, which I think will be nice to check. So in terms of the surge of FX reserves and the fall of interest rates, how that can lead to higher leverage. First of all, think about this supply and demand of assets for both advanced economies and emerging markets. And all of a sudden, what you have is an increase in FX reserves that is going to shift the demand of assets to the left, and that will lead to lower interest rates. What is nice about the paper is that it allows to connect the lower interest rates with higher leverage because the borrowers are constrained. So whenever there is a lower cost of debt, what is going to happen is that these intermediate producers who face this convex cost for issuing defaultable debt are going to increase the leverage of their firm. Okay, and actually this is a formula that is in the paper that Vincenzo didn't show, but I think it's interesting because it highlights how what are the mechanisms of the model. This parameter eta dominates how costly it is to issue debt. So if eta is equal to 0, the interest rate is going to be constant and is going to be equal to beta. What is happening there is that if they're not facing a complex cost of issuing debt, the firms will allow to provide liquidity in times where there is a sunspot shock, as in the mechanism that they show in the paper. What I mean is, the own firms won't allow the liquidation value of their capital to drop because they have access to liquidity. But if eta goes to infinity, what is going to happen is that the firms will never leverage above the value of the capital. Okay? So the interesting case for the paper is when eta is between 0 and infinity, and that's where the probability of default is going to matter, because it's going to increase the sensitivity of the interest rate and the leverage. So it's going to make the leverage is going to be more sensitive to the drop in the interest rates. So that's one part of the mechanism that I like, and I think is novel. The other part is how these defaults are going to create losses for the producers, and by that to affect the overall economy. So here I'm showing you what Vincenzo showed also in the presentation, which is the post-default financial wealth. And these are the recovery rates. When there is a default, this falls. M is going to, by the working capital constraint, is going to affect how much you can buy of the intermediate good input. But what is interesting is that stuff means that intermediate goods and financial wealth are perfect complements. So you can write down the final goods technology and show that XT here, which is the intermediate goods that you are using for production, is just a complement of the financial wealth. And something that is nice about this is these assets here, they have a productive use. So what that means is that for the standpoint of the final good producers, they provide a convenience yield. And that convenience yield means that whenever they are constrained by this working capital, they will gain something extra for investing in those assets. And that's important because it affects a lot of the equilibrium, different parts of the equilibrium. In particular, this convenience yield is going to affect the prices of the assets. Here you have the standard discount factor, and this convenience yield will appear here for all the assets of the economy. But unfortunately, in the paper, they don't analyze the case where this convenience yield matter at the end, because they assume that the final good producer has log utility, and when you have log utility, the effects cancel each other out. In particular, this convenience yield is going to induce a higher demand for assets because it's a higher return for the asset. However, it will also induce a higher growth for future consumption, so it affects the discount factor. So the two effects are going to cancel each other out. So although it's a nice feature of the paper, it's not analyzed and it's not affecting the results. Okay, so what else? How the low world interest rates are going to lead to riskier portfolios. So you can apply a standard asset pricing formula to the previous equations, and you will find that the interest rate here is the world interest rate. That's the risk-free interest rate. When this drops, expected returns for the assets are going to be lower. And this downward pressure on the interest rate, what it does is induces search for yield. And this search for yield, what it generates is riskier portfolios. So when you combine riskier portfolios with high leverage on the borrowers, on the size of the borrowers, what ends up is with a higher probability of being financially constrained as a whole. Okay? And what it means is that there is higher macro and financial volatility because those events are going to happen more often. The other part of the paper that I really like is this idea of a bailout mechanism, which is reserves can be used to bail out the losses of the final good producers. So what the paper does is, let's think about the use of reserves that partially compensate domestic investors for their export losses. And they propose this formula here, which means the bailout is going to be a fraction of the loss. And the fraction of the loss depends on the ratio of the FX, the stock of FX, and the losses that the private sector is suffering. So what they found is that bailouts reduce volatility in EMs, in particular because FX reserves are really high or really large relative to the losses, which means that the bailouts are really large, which reduces the impact of the defaults. Okay. They also find that in advanced economies, this type of bailouts don't work, and it's because the reserves are really small relative to the potential losses. But I should also add that advanced economy governments have other tools, like these bailouts can be debt finance, for instance, and obviously they can always expand the balance sheet of the central bank. That's not new. Okay. But I will focus now on things that are important about this bailout mechanism. In the model, there are incomplete market and financial frictions. So it seems that the bailout mechanism is welfare improving in some sense. The bailouts are state contingent, which means that they are tied to defaults, which are tied to the realization of the sample and the leverage, which means that I think that's good. Also, by design, the bailouts are going to partially compensate losses in both regions. However, some bailouts may occur when financial wealth is just abundant. And in that case, I wonder if this bailout is just inducing more leverage at the end of the day. So it's a potentially suboptimal characteristic of the bailout. Also, the relative sizes of the bailouts are not coordinated across regions, and hence there is no, by construction, they are not focusing on enhancing risk sharing. There's a couple of 1 minute more, please. The paper talks about macro volatility. They showed the volatility of GDP, but I think the model also has implications for the level of credit spreads and the volatility of credit spreads, and I think that should be also in the analysis. What is strange about the paper is that it shows that volatility of GDP is increasing across histories. That's not in the data. Observed volatility has been falling. So think about what is going on there. Obviously, there are different reasons. I think the model captures some of that because there are exogenous variables that are going to capture better macroprudential policies and stabilization policies as well. But one aspect that I would like to highlight is that risk may be disguised in other moments of the data, like excuseness. And actually, there are papers showing that negative excuseness is correlated with leverage. I think the paper should also look at that moment as well. That's it. Thank you very much.
Vincenzo, do you want to reply first, and then we do a short question?
No, thank you very much for the discussion. So mostly was describing the model. So I see as a criticism the fact that when you look at the data, the volatility in the data hasn't gone in the way we predict. I would like to make 2 points. First of all, thank you for pointing out the skewness, because in some sense, what we are trying to capture here is really those exceptional events related to crisis, which happens very seldom, and because they happens very seldom, it's not so easy from the data to construct really a measure of change in volatility. So, if I understood correctly, you show pre-moderation, post-moderation, right? in some sense, we already are in the moderation. At least that is the period that we consider, because we focus on the 90s. We start in the 90s. So in that sense, I'm not sure whether if we focus really on the 90s, starting in the 90s, I'm not sure that you can really see a decline in a volatility, even though you do the standard business cycle volatility. But there are some other suggestions that I think are useful, and I'm definitely looking at.
Okay, so any questions? Okay.
I was thinking about how you model collateral constraints here. And I was thinking, so if I understood correctly, the role of public debt is when public debt goes up, interest rates go up, and then these firms borrow less, right? But then, so I have two comments about that. One was that there is another role of public debt during the financial crisis, that they increase the supply of safe assets, and they allow for more financial intermediation. And in a sense, they relax borrowing constraints. And I guess that will go in the opposite direction in a sense. And maybe that's something that you can capture in the model by allowing for some collateral, different collateral value of public assets. And the related comment is that what we observed in the financial crisis, so interest rates continue to go down, but at some point financial conditions tighten, so firms could borrow less. I guess that would be also different to your implication.
Yes. There are two ways to think about financial constraints here. One is the borrower, okay, but the other is the working capital constraint from those producers. So when the government actually issue more debt, provide more liquidity, actually those working capital constraints becomes less tight. So that is actually the value of working capital, is that provide more liquidity. Now this liquidity gets accumulated, and now those producers, they face less tight borrowing constraints. So in that sense, it's consistent with your idea that after the financial crisis there was this provision of liquidity. What is not consistent is that in our framework the interest rate goes up. Okay, while after the financial crisis we know that the interest rate went down. But in terms of tightness, the more public debt actually, safe public debt actually makes a constraint in the model less tight.
No, a quick comment, so I guess the probability of a crisis in the paper is given by this shock, epsilon, that is moving, I guess, kappa. Like in sovereign default, I think like there are a few papers that they show that the countries may want to accumulate reserves to prevent something like self-fulfilling crisis or lower crisis. So in some sense, this would complement that, but like the probability could change with the accumulation of reserve.
Yes. Yes, no, very good point. I didn't have time really. It was the comments I wanted to do at the end on the conclusion. I didn't have time, but yes, you are definitely right. That. Absolutely. One point I would like to say. There are two ways to think about the macroeconomic implications of a crisis. Okay, one is through the probability. So in other words, the probability is going down. Or could be maybe the probability doesn't change, but the adjustment that needs to be done will be different. Okay, so we don't have the probability in our case will be constant, but it operates through the second mechanism.
Manuel, the last question, and then we can continue discussion over break.
Vincenzo, that was a nice paper. I find it still hard to see how you will, how you are dealing with the opposite story.
Okay.
Which is that countries accumulate a reserve because they were expecting to face bigger and larger shocks, and in that case, reserve is the reaction to an increase in volatility. Tim and I had a student actually was working, Juliana Gamboa, she was working on something like this, when looking across the cross-section of emerging markets, those that were potentially facing higher volatility, accumulated reserve, but interpretation is on the other direction. And I don't see how, how can you, maybe you can fit in an accumulation of reserve process that is self-dependent in the model of the expected volatility of the shocks. And that will give a little bit the model the possibility of having the other edge channel operating.
Yes. No, I agree. Here, in some sense, we do a more limited exercise. We see what happens to public debt and foreign reserves from a general equilibrium approach. Let's see what are the implications. But definitely, you are right that I would be interested to understand about why they accumulate those reserves. I totally agree.
Okay, thank you very much. We'll be back at 11:30.
So thanks very much to the organizers for the opportunity to present. This is joint work with two colleagues in Korea. So the paper is about how capital market policy, including both reserve accumulation and capital controls, potentially can contribute to productivity growth by shaping the composition of trade in terms of sector and also affecting industrial structure. Now, the particular application I want to focus on here today is how this can help explain some phenomena noted in recent literature, premature industrialization and industrial polarization. The latter has been emphasized in a recent paper by Sposi and Zhang. They note that increasingly countries are passing through the industrialization phase on their way from agriculture to services. And also they document that there's an increase in the cross-country dispersion of the manufacturing share of output. And they emphasize that this increasing dispersion is accounted for largely by two distinct groups of emerging markets. On one hand, you have East Asian economies which have sustained relatively high manufacturing shares despite the deindustrialization we see on average. And on the other hand, you have emerging markets in Latin America with a rather different experience. Now, their explanation in their paper focuses on sector-biased productivity growth and trade integration. And when I saw their paper presented at a recent summer institute, I commented that there were also things going on with capital account policy, exchange rate policy, during this time that are quite different between these two groups of countries, and that policy might be part of an explanation. They were completely unsympathetic to that explanation. I think there's something there, and we'll see if I convince you. So you could say that we suggest that differences in capital account policy and exchange rate policy contributed to the sector-biased productivity growth that they document, but it's endogenous to the policy choice, and that's contributed to productivity growth and polarization. Now, the seeds for an explanation connecting capital account policy to polarization and productivity growth exist in a large literature documenting how currency undervaluation, with particular application to China, potentially may have contributed to a large manufacturing sector in some countries, again in particular China, through learning by doing and trade surpluses. And there's ongoing interest in this topic, witnessed by two recent JIE's articles on this topic, and Pablo's paper presented at the NBER IFM program meeting last March. Excellent paper. I am learning a lot from it. Some of it will be reflected in my presentation today. So the idea is that a sustained currency undervaluation associated with policies of reserve accumulation combined with capital controls have coincided with periods of rapid growth among East Asian economies. And I will motivate this with a figure that is similar to one you saw in the last presentation for motivation, with the exception that I've added another line specific to East Asian countries documenting that the reserve accumulation during this time was particularly strong among East Asian economies. A lesson coming from this way of thinking about reserve accumulation is that it's yet one more reason to qualify the advice that we often give to emerging markets based upon the simple versions of our intertemporal models, emphasizing the benefits of free capital mobility as a source of financing for investment and development, also allowing consumption to be smoothed along the way. What this approach suggests is that there's a tension between the financing of investment and development versus the implications that capital flows have for the motivation or incentive of firms to create, invest, innovate. And we want to emphasize that latter part of implication of capital flows, but I will acknowledge, and we'll see in some of the later simulations, if I have time to show you, that there is a tension there between these two implications of capital inflows. So what exactly does this paper do? Well, there's an empirical contribution and a theoretical contribution that we view as novel to the literature, in particular in relationship to this, the literature documenting growth through trade surpluses and learning by doing. So first, it's common in that literature to show an association between currency undervaluation and productivity growth sector allocations. We find that we are able to get more robust empirical relationships if instead of looking at the exchange rate as an explanatory variable, we focus on the capital account policy and the reserves accumulation per se. If one wants to use the exchange rate undervaluation as the explanatory variable, you have to deal with some complicated issues such as what is the equilibrium exchange rate against which you're going to measure the undervaluation? Complicated. What is the elasticity of trade surpluses with response to the exchange rate? Do you use the large trade elasticities or the small macro elasticities? Another complicated issue. Well, we sidestep that issue because you really don't need to worry about those things, because what matters for this mechanism is that you have a trade surplus to trigger demand for your manufacturing goods in the export sector. And a macroeconomist can tell you that by looking at the balance of payments constraint, an identity, which must hold, that in the context of complete capital controls, there's a direct connection between reserve accumulation on one hand and a trade surplus on the other, whether or not how much the exchange rate will depreciate and how sensitive the trade balance is to the exchange rate will balance each other out so that the identity is satisfied. The main point is it'll lead to a trade surplus, which could trigger these other mechanisms. The other empirical contribution is that we also consider effects on other variables associated with firm dynamics, such as the number of incorporated firms, the extensive margin of trade of new products, and the domestic sourcing of intermediates, which has not been considered earlier in this literature. And that's motivation for our theoretical contribution, in that we're proposing an alternative externality, an alternative mechanism by which the trade surplus leads to productivity growth. We want to view this as an alternative micro-foundation, or an alternative to the learning by doing mechanism common in literature, or perhaps a more developed or detailed micro-foundation to it. In the end, we end up concluding that it's probably best viewed as a complementary mechanism because we find that they actually work in a reinforcing, amplifying way to each other. So in particular, we're going to borrow a mechanism or a theoretical model from the trade literature, referred to as firm delocation, a different type of externality, seen first in Krugman and developed in a JPE by Osa, in which the change in the number of firms engaging in exporting between countries can lead to welfare benefits for the country that has a greater number of exporting firms. Now we're going to add to this mechanism a roundabout production structure, which will translate the benefits the trade is documented for consumers in terms of the consumption index, and translate it to firms in terms of productivity gains. Another contribution is that we're going to be extending what is usually a simple small open economy model, studying learning by doing, to a two-country context, which will allow us to have a window on what's happening to the rest of the world or the other countries. While one country is benefiting, how are the other countries not benefiting? Okay. This work intersects with a number of related literatures. A few of them I've already mentioned, but let me briefly highlight a few that I haven't talked about. The literature on firm dynamics tends to ignore implications of exchange rates. Going back to an influential paper by Rule, arguing that exchange rate fluctuations and exchange rate policies are generally too short-lived in order to affect long-run decisions like firm entries subject to a sunk cost. Well, we would point out that the currency undervaluations that we're talking about here, sustained by long periods of reserve accumulation and capital account policy, are long-lasting enough that one might expect they would have implications for issues of structural change like firm creation and sectoral allocation. There's also a literature on debt overhang documenting the relationship between reserve accumulation and growth. I would just note that we're proposing a particular mechanism by which that connection might be supported. So the plan of what I'd like to present today is I want to show you the detailed empirical results we're using to motivate our theoretical model. I'll describe the key elements of that theoretical model. I'll do a quantitative simulation, and depending on time available, I'll discuss some extensions and limitations. And I can leave it to my discussant and comments to mention other limitations. So the data set we're using for the empirical work considers 45 countries, about half emerging and half advanced. Over the period 1985 through 2007, ending before the crisis, results are similar if you extend the data set, slightly weaker. Our regressions will involve 5-year averages in order to capture longer run effects. And our key regressors are 2 dimensions of capital account policy. First, a measure of capital controls, which is based upon the Chin-Ito measure, but we invert it. So a higher value indicates increasing degrees of closedness. Then we'll also measure changes in reserves as a share of GDP. And then the variable that we're most interested in is the interaction of those 2 things. So reserve accumulation under a degree of capital closeness. We also had to work a bit to collect data on the firm dynamics variables, which are not usually considered in this context. We had to search a bit to find some measures, and if others have ideas of where else we could collect the data on, say, shares of intermediates, we'd be happy to hear. So here's our first regression of changes in labor productivity on our capital controls, changes in reserves, and the interaction term, along with a number of other controls. We'll have both country and time fixed effects, and because of the lag dependent variable in there, we'll try to control for endogeneity with some instruments. And I'll show you results, both just the panel regressions and then a system GMM, which tries to control for some of that endogeneity. So the key result here is that we have statistical significance on our interaction policy variable when it comes to the manufacturing sector. So productivity growth increases in response to reserve accumulation in the presence of capital controls. But that's specific to the manufacturing sector. We do not see evidence of that effect in productivity, labor productivity in the non-manufacturing sector.
So
sorry, can I ask a quick question here?
Sure. No. How do you know that it's not reverse causality? The productivity growth leads to growth, the money demand goes up, and the monetary approach to the balance of payments tells you that reserves will go up.
It's a good question. We attempt to instrument the potentially endogenous reserve accumulation in a couple of ways. One with lagged instruments, using lags, other with an instant. So first of all, it's not easy to instrument. The only instrument we've seen was used in the JE 2022 by Taylor and my co-author, looking at reserve accumulation resulting in countries that are commodity exporters where there's a change in commodity price and they have regulations on retaining foreign currency. So those are clearly exogenous changes in reserve accumulation. Not the best instrument for our case because our focus is not on commodity exporters, but actually reserve accumulation linked to manufacturing. So its significance is reduced, but we still get some effect there.
No, but
when you use lagged instruments, it still works pretty well.
It's a mechanical thing. If you have growth and the money demand goes up, you don't print money, then the monetary approach to the balance of payments says that the change in reserves is equal to the change in the quantity in money, and that's it. It's accounting.
I'd have to think more. I mean, I reviewing this as a policy choice, we do see differences across countries and try to control for endogeneity. But I'll have to think more how better we could do that. You have a question over here?
Just to understand. No.
So this is saying I put capital controls and reserves, get possible effects in TSP growth, right? So are there cases, what I don't understand is this seems to be saying I should do this all the time then, right? I mean, because I do it and it's great, but are there instances in the data set where actually this didn't happen? Or kind of just to wondering whether it should not always work. Otherwise, everybody should be doing this all the time.
Let me get back here.
Sorry, so I have a similar, maybe I can have my question because it's kind of related. What is the variation that is that is actually getting you this coefficient?
It's variation over time within a country. So you have both country and your fixed effects. So some particular countries, during the periods they're doing more reserve accumulation, they have productivity growth in the manufacturing sector over this 5-year period. Yeah. Interpreting the quantities here, it suggests that at least for the experiment, in terms of the experiment, we're going to be running with 5% reserve accumulation annually, which is the average in China during this period of time. That reserve accumulation is generating about 1 percentage point extra productivity growth per year.
One quick question. Why do you invert the capital control measure? And are you concerned that those countries that are close to zero in the original measure are being overweighted in the regression?
We just did it for ease of interpretation because we want to have we want the interaction term to be positive and associate the sign of the effect that way. We could try inverting it to see if it has an effect. The other contribution empirically was to regress firm dynamics variables on the reserve accumulation. See if I can get the right button this time.
Paul, sorry, one question. Did you say how you measure the capital controls?
It's the inverse of the Chin-Ito index. Okay. So increasing.
But that's very flat, right? I mean, it's super flat.
Yeah, I don't know what the standard deviation is. There's enough variation for us to identify off of it, both in time and across countries. That is enough. We're open to the ideas of using alternative measures too. Now, regarding the firm dynamics variables, we find that this interaction term is associated with increasing shares of labor in the manufacturing sector, consistent with our theories. A rise in the extensive margin of exports very strongly, so export of new products or new firms doing it, not the intensive margin. So it's not just the same firms exporting the same products. There's some extensive margin activity here. We see an increase in the number of listed firms and also an increase in the domestic share of intermediates being used in production. Those dimensions are going to play a role in our theoretical model of where the productivity growth might be coming from. So let me move on to the theory. In the interest of time, let me summarize the contours of the model, and I'll show you highlights, I'll highlight certain equations that are important for the result. This will be a two-country model rather than small open. There will be two sectors, a traded sector and a non-traded sector. The traded sector is where the interesting things are happening. We associate that with manufacturing. These goods are differentiated, so they're monopolistically competitive. This is the sector where firm entry occurs, subject to a one-time sunk cost, motivated by the fact that these firms generate profits. So the profits are being used to justify the payment of the sunk cost up front. They will face iceberg trade costs, but no fixed cost of exporting. And we will consider the possibility of learning by doing mechanisms, but we argue that that's not necessary in order to generate the productivity gain. you can do it in a more endogenous way. We also specify that this manufacturing sector uses a composite of other final goods in production. So this is a rudimentary type of production chain in which firms use the products of all other manufacturing goods, both domestically and abroad. So it uses the same index over tradable goods that consumers utilize. And the home government can use reserve accumulation and capital controls. In our simple model, we assume there's no private international asset trade. We are considering relaxing that with taxes on asset trade, but for the moment, it's completely closed. They can use that combination of policies to choose a real exchange rate, and this is in the absence of price stickiness. So this is not a Keynesian model in the sense we don't need any price stickiness because under the capital controls, the government has control over the nominal exchange rate and it has control of the price level. It hence has control over the real exchange rate. And our goal is to track how undervaluation through reserve accumulation affects firm entry, manufacturing shares, and labor productivity. Let me skip over some of the standard elements. In particular, the consumption index is standard, household problem, intertemporal optimization of utility, of consumption. This is a nominal model with money. We did that just so that we can compare it to new Keynesian models and endogenous labor supply with the usual first order conditions. And let me linger more about over the description of the manufacturing sector. So I mentioned that production uses not only labor inputs, but also a composite of other manufacturing goods in a Cobb-Douglas aggregator. We abstract from firm heterogeneity in this model. What matters here is the number of firms, not their location on a productivity distribution. We could add that, but I don't think it's going to change the results very much. The question is how many firms are producing and what country they're located in. And shifts in that extensive margin will have productivity implications. These firms prepay a one-time sunk cost in units of, I say here combined labor and differentiated goods, but in the version I'll be showing to you, the sunk cost is in units of the manufacturing goods, and that has implications for encouraging entry. That's going to help amplify things. We have no fixed cost of trade, so all of our manufacturing firms will be engaged in trade, so there's not a margin in that dimension. It's just a firm. The only margin active here is the creation of new firms, all of which export. The decision that these firms make are based upon their desire to maximize firm value, the discounted sum of the stream of profits using household discount factors as the owners of the equities in the firm. Profits depend upon sales net of production costs, where the demand comes from consumption, creation of new firms, and payment of entry costs. Firms have a choice between using labor and intermediates as inputs. They set prices, but not subject to any stickiness. So it doesn't matter what currency their prices are being set in. But an important condition is the decision of whether or not to enter the market. Firms will enter progressively until the value of firm falls to the point of the entry cost. Now, in the absence of firm heterogeneity, we can't make a statement about which firms are entering the market from a given country. But given that there's no heterogeneity, it doesn't matter which firms from a given country are entering. It just matters how many firms from a given country are entering. The non-traded sector is simple in the sense that it is assumed to be perfectly competitive. So there's no product differentiation here. Now, another element of the model I want to linger a bit on is the specification of government policies. We use a simplified version of Chinese monetary policy from Chonglu and Spiegel, in which the government purchases foreign bonds as reserves and then sterilizes its effect on domestic money supply through taxes. So to simplify things, we just specify that the government holds constant the domestic supply of bonds. The domestic agents are limited to holding domestic bonds. The government sterilizes effects on monetary policy. So when the government is changing holdings of foreign assets as reserves, implicitly it's all being paid for by lump sum taxes in this specification of the model. So very simple. We will specify a policy rule governing countries' government's choice of reserve accumulation.
Can I ask you, can you go
please.
back one slide? So this is the discussion we're having before. Like, if you're accumulating reserves, you have to increase the money supply, but what you're saying is that they are changing, they are instead of using the seniorage to buy the reserves when the money demand goes up, that they keep the M constant and they use taxes to accumulate reserves? Is that?
That's the theoretical specification. I think it would be equivalent to assume that you could also finance, so there are different ways of financing the reserve accumulation. As you note, you could also issue bonds, which the domestic agents are forced to purchase, so it's forced saving. In terms of this model, those are all equivalent ways of accumulating reserves, as just making them pay a lump sum tax up front.
But in terms of the regression,
there are no nominal rigidities or anything like that.
In terms of the regression you showed us before, it makes a hell of a difference, because if you make the growth in M homogeneous of degree 1 in output in real terms, that is probably an implication of the way you set up the model, then M will be growing over time, and you can use that seniorage to give the transfers lump sum to the public or to buy the reserves. And that's like that. So in some way, if you want to test if there is reverse causality, you want to take that equation to the data, and it's not innocuous a choice that you're saying is equivalent in terms of interpreting the regression you had before.
Fair enough. So in future, we can check that. Yeah.
But
In
just
the context of the model, it doesn't make much difference, but I realize that's a simplification of
a
reality.
little bit, Ricardo equivalence here is failing because the households cannot undo the net foreign asset position that the government is taking abroad. So the government, you have lump sum tax, and it seems like, that should not matter, but it's just the government is saving a lot outside, and the household have no way to undo these savings.
That's right. Under the capital control, so if we did not have capital controls, then the optimal choice for households would be to take the opposite position of the government. They would just borrow abroad in order to intertemporally smooth their consumption, and then you'd have recording equivalence. We block that with capital controls. But if you want to manipulate the real exchange rate, you need that combination of policies. That's right.
You can also have some financial markets imperfection instead of the policy. That's
fair enough. In this environment, the government has the ability to choose. Well, you can either specify a rule in which they're choosing the real exchange rate, or equivalently, they're choosing a path for reserve accumulation, and then the exchange rate becomes endogenous. We've gone back and forth between those two different ways of specifying the government policy rule. In this case, we'll just be specifying a path of reserve accumulation. In either case, this will determine the real exchange rate, and the monetary policies will be setting price levels. They'll be sterilizing the reserve accumulation. The other equation I wanted to mention was the balance of payments condition. In this context, with complete capital controls, the balance of payments condition boils down to accumulation of reserves equals the trade surplus. So if one of these is being treated as exogenous, so whatever endogenous mechanism is required, it'll affect the trade surplus. No need to worry about what exactly the path is of the equilibrium real exchange rate. It'll happen. In the interest of time, let me summarize in words the theoretical mechanism, and I'll show you some impulse responses from the theoretical model and numerical experiments to illustrate it. So the reserve accumulation with capital controls, yes, implies a trade surplus, which raises demand for home traded goods. That's going to induce a rise in the entry of home firms in response to the increased demand that they face. So they have an incentive due to increased expected future profits to enter the market. In the rest of the world, with the increased domestic entry, you will see a fall in firm entry and firm exit in the rest of the world. So you'll see rising industrialization in the country with the policy, and you'll see a decrease in industrialization in the other. This will work through a production delocation externality as described in OSA. There are benefits from concentrating global manufacturing in the home country. In the particular mechanism that they describe, if a greater share of the manufacturing goods are produced domestically, that leads to trade cost savings. In the trade literature, that raises welfare through by reducing the price index for consumption. In our context with roundabout production, cheaper price of inputs leads to a rise in productivity. That can work through a couple of channels. You'll use more intermediate inputs, which raises the marginal product of labor. Also, changes in relative prices will raise the valuation of home output used to measure labor productivity. We have some analytical results in the paper demonstrating, but that's the main point. Let me describe.
Can I just ask a quick question?
Yeah.
I'm back here. In the regressions, you made a big distinction between regular reserve accumulation and that interacted with capital controls.
Mm-hmm.
But in the model, it seems like any kind of reserve. Say the households become patient and they just want to save abroad, that would generate the same mechanism. It would also generate a change in the real exchange rate. And so there's nothing particularly special about capital controls in the model, or is there?
If it's the trade surplus that'll do the job, and here the trade surplus is being generated by the policy. That's our point. So there are other ways it could happen. Here we're saying that a policy of reserve accumulation can make it is one way to make it happen. That's the point we're making. Okay, we'll start from a symmetric steady state in this two-country world with no reserves, balanced trade, and a real exchange rate of 1. The home country then adopts a policy of purchasing reserves. In this version, 5% of GDP per year for a period of time, which was the average in China during this period. So this change in policy is a surprise in period 1, but then thereafter it's perfectly understood through perfect foresight. And we assume that private international asset trade is completely precluded here. So we're going to solve for the equilibrium as a nonlinear forward looking deterministic system. Parameterization is entirely standard. And here I want to show you basically 3 sets of impulse responses depending on the time that I have. What's happening with these endogenous variables? First thing, reserve accumulation translates into real exchange rate depreciation of about 3%, but it attenuates over time. Partly that's due to Velásquez-Samuelson effects. As you'll see in a minute, this policy is raising productivity, specifically in the traded sector. Velásquez-Samuelson says that it leads to endogenous real appreciation. So unless you ramp up the reserve accumulation to counter that, you'll see some attenuation in the real exchange rate, depreciation. And in fact, in some of the simulations I'll show later, this might be so extreme that you end up with real exchange rate appreciation over time later on in the sample, but you're still running, you're still generating because of the productivity gains, but the policy still works. It just goes to show that the relationship between this reserve, the relationship between reserves and the trade balance is more direct than what you might be able to tell just by looking at the exchange rate as the intermediary variable. We see a rise in home GDP that's partly coming about from a rise in home labor supply. They're paying taxes, so they're increasing labor supply. But I want to highlight that there's a larger proportionate rise in home labor in manufacturing. So you see a reallocation of labor out of the non-manufacturing sector into manufacturing. And then I want to highlight the implication this has for firm dynamics. Initially, so you see a rise in firm entry in response to the profit opportunities. But one thing that surprises, it takes several years for that to ramp up. And I think that reflects the fact that real interest rates are rising here because households are being forced to save. They're going to have higher consumption in the future. There's an increasing opportunity cost of financing investment, including in firm creation here. So it takes a while to happen. So this policy is creating an incentive for firm creation, but it's also raising the cost of firm creation, and there's a tension there. It just means that it takes a while for the firm dynamics to kick in. In the very long run, you see a reversal of all of this because in the long run, when the policy stops, the country has a positive net foreign asset position and interest earnings. In the long run, everything reverses itself. And the last thing I want to the next thing I wanted to show is the effect this has on foreign variables and on domestic value added. So you are increasing manufacturing value added at home during the period of the policy, but it reverses later on when the trade balance reverses. And you see the mirror image in the foreign country. Here's the polarization and deindustrialization at work. Manufacturing productivity does rise. It falls initially because the output is going up with labor input. It goes up later on due to firm dynamics. So you'll see the dynamics of manufacturing labor productivity track very much what you saw with the firm entry. Without firm entry, you see absolutely no productivity gains in this model. It's all coming from the firm dynamics.
Can I ask a question? Sorry, I'm not maybe following. So away from the dynamics. So let's say I want to compare how a state with this policy is not present, and I'm thinking about adding this policy, and I compare across the states. Should I expect that aggregate welfare will go up or not?
Welfare is a somewhat complicated issue, as we've learned from Pablo's work. There are short-run gains. You go back.
Yeah, but
short-run gains. Yes, home utility falls initially, but you benefit later on. And in the interest of time, can we save that for the discussion? I think I'm running short. The one extension I wanted to show you is interaction with the more standard approach of learning by doing. We tried a number of different versions of learning by doing from the literature. One critique we would have is they're rather reduced form in nature, which has the benefit that you can do more what you want with them. Our hands are more tied because we're trying a more structural, micro-founded approach. We tried a number of versions. The one that I wanted to show to you is emulating that in Pablo's paper that was presented at the program meeting, in which there's an upper bound, and once you converge to the upper bound of productivity, the elasticity of learning by doing disappears, and so then once you acquire this new higher level of productivity, and it becomes permanent with permanent productivity gains. So I want to show you, first we computed what the optimal policy is, the optimal path of reserves, period by period. In our model with just learning by doing, it looks a lot like what Pablo had, gradual reserve accumulation over a relatively short period of time, but the 10-year period. I then included firm dynamics, and we found some puzzling results. The main point is that with firm dynamics, the productivity implications are amplified. That's both good and bad because now it takes quite a long time for the firm entry to occur. So during that period, you're slowing down productivity growth, but in the very long run, you see a very big amplification in the productivity gains when you have firm dynamics. So learning creates more firms enhances the learning, they both work together, but it takes quite a while to get there. When you have when we compute the optimal policy, specifically for the model with learning by doing and firm dynamics, we find that the optimal reserve policy is larger, and you see also significant amplification in the number of firms being accumulated, and it happens somewhat sooner. When it comes to welfare, we can talk about that more in the discussion. As Pablo points out, in order to have welfare gains, you would like to have a policy that leads to productivity growth that is not reversed in the long run. Learning by doing has a ready way of doing that by introducing an exogenous path of productivity. It's not so clear you can do that in the context of endogenous growth through learning by doing, through firm creation. Very good. I won't reiterate the conclusions. I'll just mention one extension. This mechanism may not work, or this tool may not work well for a country that is a commodity exporter by endowment. We find that in our model, if you take that non-traded sector that's not differentiated and make it a traded sector, having that second traded sector can invert the production delocation mechanism. And the reason is that if you're using this reserves policy to undervalue your exchange rate, the sector that has the higher price elasticity is going to respond more to that. And that's going to be a sector that has less differentiated goods, which if you make that a traded sector, if you're a commodity exporter, currency undervaluation may actually lead to deindustrialization itself because you're promoting the export of a non-differentiated exported good. So it can be flipped.
All right. Thank you for the opportunity to discuss this paper. It's a very interesting paper. You know, the main question is how capital flows, and in particular capital controls, may be driving, you know, productivity growth and structural change. I go directly to the empirics. You know, in the empirics, something that I like is that they study exactly, you know, that question that I explained. That is a question in the introduction of the paper. The focus is on this result here. You know, you can have I can add, you know, the magnitude of this, of an economy that fully restricts capital account and increases reserve by 1 percentage point, reserve to GDP, in a period of 5 years, has a higher labor productivity of 1.37 percentage point during 5 years. So the effect is also quite large. They highlight the difference with the non-manufacturing sector. The second result, the one I highlighted here, is about that the same explanatory variable, capital controls, interacted with the growth in reserves, increases the share of labor that is in the manufacturing sector. So there you have, you know, the answer to the question. The answer is that yes, you can increase labor productivity. So this is important. At some point, someone mentioned TFP. This is labor productivity in the manufacturing sector, and you know, it increases the share in that sector. It's also nice that they analyze what is the mechanism behind this, because that's kind of how it's going to work in the model. You know, it's through the extensive margin, and it's through the number of firms that are exporting. So I'll have a few comments on the empirics. They are quite simple. So one is, and it was mentioned, Paul mentioned that toward the end. It's like, what is the non-manufacturing sector? You know, so I guess the way they construct is everything that is not manufacturing. But in there, you know, in the model, we want to call this sector the non-trade sector. You know, and in emerging market, a lot of export are coming from the agricultural sector. In some economies, it's coming from the IT services that are exporting. So that also would be in the non-manufacturing sector. So it would be simple just to try to, you know, split the non-manufacturing sectors in traded and not traded sectors. The other one, and this was brought up a little bit with the change in reserve, but I think it's also important for capital controls. You know, the capital controls are not exogenous. So at least it would be nice to see, like, one way to see this is like, you know, take the periods when capital control, the index is high and when it's low, and let's compare some variables. You know, what is the growth of GDP? What is, to see if we see that this is
clearly, I don't think it will be random. You know, I'll expect this to change. Continuing with capital controls. Okay, sorry. Can I go back one slide? This one? Okay, I can go. Okay. Okay. These are not the latest slides that I sent, so I'm going to go with this. But I'll mention one slide that I added that is not here. The previous one is that I just computed kind of the evolution over time of this index of capital control, and you see like the title was like the popularity of capital control, and you see a very clear decline. You know, in the 70s and 80s, the average was something like 0.7, and now it's something like 0.3. So there is a variation. So the popularity of capital control, although this paper is arguing that it may be important, you know, it has declined clearly over time. That didn't prevent Argentina from implementing that. You know, so what I put here is, yesterday we talked a lot about Argentina. I thought that today somebody should mention Argentina. So I added Argentina here. So you see, Paulina was saying there is not enough variation. It's kind of flat. You can see that not in Argentina. You know, yeah, you know, it goes from almost 1 to almost 0 in a period of 30 years. I also added the labor share in manufacturing. So the labor share in manufacturing is, you know, it moved like as in the regression. In the updated slides, I also sent the trade balance, and you also see at the beginning of the period after. This graph is also to show that this is not exogenous. You know, the big tightening here is, you know, after the Argentinian default. You know, so that was high here, and it's also associated, you know, with changes in government, and it takes us a little back to yesterday's paper. But you also, if you look at the trade balance that it was emphasized, you know, it was equal to reserve accumulation in the month. You see that the trade balance here, it was very high, you know, and it's decreasing over time. This may also point to the idea, maybe Nick or someone was asking, you know, are you doing this forever? How long you're doing? You know, this, in terms at least of accumulating reserve, it worked for a few years, but, you know, you can see this declining over time, and we know that this wasn't, you know, a great, in particular, a great period for Argentina, a period in which the index is high. Okay, going to the model. You've seen the model, 2 countries, capital controls that mean that residents can, as Manuel was asking, cannot undo what the government is trying to do. I copied one equation that I think is important, and Andy was asking a little bit about this equation. They're assuming that here, this is the equation. This is how the accumulation of reserves is going to be financed, and, you know, have 3 sources, but they're going to shut down the growth, the seniorage, and borrowing. Okay, they have things that I underlined here. It means that I'm going to talk a bit more. So it's going to be financed with lump sum taxes. They have 2 very different sectors. The non-traded sector is very simple, homogeneous good with linear production using only labor. And they have a sector, the traded goods sector, that include a lot of details, differentiated good, inputs are labor, and differentiated varieties. This input G, that is a composite of different varieties of intermediaries. The problem is dynamic. There is entry and there is exogenous exit. And then later in the paper, you know, they add learning by doing, you know, explicitly an equation for learning by doing. You just saw the results. I just wanted to highlight that I included the one that have to do with the question at the beginning. You know, you have the accumulation of reserves. As Paul explained, you have the evaluation. The way I interpreted the evaluation, I guess, is simple. You are accumulating reserves. It means you have to have a trade surplus. The only way the prices have to adjust so that happens. So that is what was happening there. The increase in labor in manufacturing and in total, you can see in manufacturing increases more. So that means the share. It would be nice just to have the graph for the share, you know, but it means the share is going up. And labor productivity, you know, if I look at this graph, I'm not sure labor productivity is doing what they want to do based on the regression. You know, it's going down, then it's going up, then it's going down. it depends kind of on the period that you look at that. So the comments on the model, in my work that I have with Julian and other authors, we show that the optimal monetary policy depends a lot on the ability of the government to finance monetary policy, the backing of monetary policy with lump sum taxes. So my hunch is that if taxes were distortionary here and you have to finance that with taxes, the result would be different. You can see that, for instance, these policies announced, like households in the model work more. For instance, if you have to finance that with taxes on labor, that probably is going to change. The sectors are very different, and in the empirics, they highlight the different result. In the model is kind of by construction. One model, there is no chance that in that model it will happen. So I don't know, like it would be nice to see kind of evidence in the data that there are this clear difference between sectors. The fact that they use intermediaries, because like in the non-manufacturing sector by construction, there is not much action. Then other comment is on the importance of this price PT. The way they assume is that the assumption that they make is that intermediate input G and CT has the same variety, so it's the same price, this price PT. That implies that labor productivity, again, labor productivity in manufacturing depends on this price. The way to think about that, if it is cheaper to buy intermediate input, just buy more intermediate input is complementary to labor, so labor, is more productive just because you are getting the other input. But that price is not that clear in the model, like how that price moves. The interpretation is that you are not paying the cost to bring the goods from outside, but I think you are doing that because they become more expensive. So at the end, I'm not sure I understand that movement. I'm going to say quickly, entry, they assume entries in terms of goods or this price PT is another place. So this price, as the intermediate get cheaper, that is what increases labor productivity, you also have more entry. It's common in this model many times that do it in terms of labor, wages. So I wonder how that would change the result. Also, the structure of the differentiated products. Here is you can substitute the goods coming from abroad with the local goods. So what if these goods were kind of unique? So I think, and the last comment on learning by doing. Again, they add learning by doing kind of later, and it's the same way that they were added in the presentation. Quantitatively, they change the results a lot, and so I think they have to think more about how to introduce that and what they want to do with learning by doing. It looks like if you introduce learning by doing in the way they did it, that's the paper should be about that, at least the size of the quantitative result, and that would dominate. But that's it. Thank you.
Thank you, Juan.
Reply to a few of your observations. So yeah, thanks for the insightful and correct comments. Let's reply to a few of them. Yeah, this distinction between the short run and the long run, and this is a lesson that Pablo's paper teaches us, that you reach the new long run steady state, things can flip. What are the implications here? In this hypothetical long run, where hypothetically China's running a trade deficit, the deindustrialization that some other emerging markets are experiencing could flip. Now, are we going to reach that point in any time that we think was reasonable? I'm not so sure. Can this policy be run forever? Theoretically, that would bump into transversality conditions and government budget constraints. That raises theoretical questions of if a country is benefiting from pursuing this policy, how does one interpret transversality conditions if you're actually benefiting by giving things away? I think that's an unresolved theoretical question which we didn't want to get into here. And the bigger point regarding so the case of Argentina, endogeneity, yeah, we'll think more about that in our empirical work. I talked more about the productivity benefits for the reserve accumulating country. But I mean, you can see this argument applied to other emerging markets fairly easily. I mean, if you have large capital inflows, it drives up real exchange rates, which Argentina experienced. that disadvantages their their exporting sector, and that has implications for learning and industrial structure. Our attempt here is to provide an alternative micro foundation to learning by doing. Learning by doing has the advantage that you can build in this permanent effect. We either need to piggyback on that or develop an analog for the firm dynamics, which is something the trade literature never had to think about because they view things in terms of tariffs or transfers. Here we're trying to implement this through reserve accumulation, where you have to worry about transversality conditions. So it's a little bit different, so just additional challenges there.
Federico?
Yeah, Paul, thanks for the paper. I'm going to make the same comment I made to Pablo in Colombia a few weeks ago, which is in your structure, the non-tradables is a very simple production function, correct? So you're focusing all these effects to come from the tradable sector. So if the effects are there, well, you need the overvaluation, the change in relative prices to stimulate these things. What happens if I would say, no, the innovation is in the non-tradable sector? I mean, I was president of a bank for 6 years. I spent my whole time trying to increase productivity, huge increases in productivity. And so I don't know why, I think, I was telling in Colombia that I think this is the structure that we had when we did Balassa Samuelson, and we had like industry was the source of productivity growth, and maybe non-tradables was haircuts, which of course I don't use, but anyway, so I wouldn't know much about that technology, but I mean, the changes in productivity in non-tradable are huge, no? So we will have a model of overvaluation, no? If the productivity changes in non-tradables, we want to have an overvalued exchange rate. So I don't know, I think it's something that's worth thinking about, and I think that the process of technological progress has become much richer, much more diverse, and so I would say that makes me a little bit skeptical to a model which is just so loop-sided in terms of its setup. It's a comment, you don't need to answer.
Any other questions?
Yeah.
Roberto.
Very, very interesting paper. It reminds me a lot of a paper, a bunch of papers that you quote in your introduction, which is the work by Dooley, Garber, and Walker Landau on the new Bretton Woods system. And I was wondering, if you can usefully compare your work with theirs. I mean, in some sense, for those of you that don't remember that, or saw that, Dooley used to say, well, this is actually China's problem. It is to bring all these millions of people from traditional sectors to modern sectors, right? And the emphasis is very different because they say, then there's no demand for the new goods that are going to be produced, so China's policy will have to be to generate trade surpluses, right? And reserves accumulation, in some sense, is a side product of that, right? As opposed to the other way around, as opposed to choosing a reserve policy and the trade surplus being the outcome of that. So it's interesting to think about the comparison, partly because some of the issues that emerged that have been mentioned in your model actually are different. Like, for example, what is the limit of the policy of reserve accumulation in your model? I mean, it's not clear exactly whether a country can actually pursue that policy forever. But if a country actually doesn't care about welfare, but it cares about just like bringing people from the countryside to the cities or to the traditional sector to the modern sector, then that's not a consideration. They can just run like a reserve policy forever. Now, interesting enough, in the Dooley Garber Forster standard discussion, the limit to the policy is how many people remain in the traditional sector, right? And in fact, they actually correctly predicted. They said, this is going to take about 20 years, right? So we're seeing actually that we're reaching the limits of that kind of policy. So I want to get your comment.
So, Manuel, last question. Both of you make it short.
Yeah. Yes, my two comments are, they're very quick, but one is a big literature. I know you you work in a different area, but macro development dwells with these kind of things a ton. Most of your mechanisms are there. Okay, so I think it would be great to relate and to learn a little bit kind of how things work. For example, what Federico was talking about, the fact that you have roundabout in one sector or in the other, that's amplifying also effects. And there's a lot of studies about that in the literature. Also, because you have entry, you have the lab for variety effect. There's papers by David and others that try to correct for that. So there's a lot of things to kind of, I think, it's a good opportunity to try to connect with another literature that have been thinking about these things for a while and trying to correct issues that may pop up as important, but in non-desirable ways. But anyways, just that.
No, it's related. It seems like reserve is a blunt instrument to fix something. And it would be nice to see what alternative instruments are there that the government can use to fix, say, the relative price, which is maybe the problem.
Okay, so thank you very much. We'll have lunch now and come back at 2 p.m. Thank you.